24,000 mark as well. But more pain in the broader markets. If at all, I think we might have bounced from the low point of the day, but we are still, so the mid-cap index trading with cuts of nearly 3% at this point. Pull up the small-cap index as well and see where it is at. It's now more than 3% lower. So that brief bounce back from the low point of the day was also sold into, and you're seeing quite a bit of pain across the board at the start today. Perhaps some are saying the uncertainty over geopolitics, the tensions on the border with Pakistan playing out. But one might argue also, based on the derivative data, which I'm sure our expert will have a view on, the rollover data pointed to the fact that investors, traders are not willing to hold on to positions as well. And maybe after quite a hot rally over the past 7 days or 7 sessions, some money being taken off the table. Axis Bank seeing quite a bit of a cut today, 4% or thereabouts. A lot of the frontline companies seeing sharp cuts. Joining us this morning is Sameer Dalal, Natvarlal & Sons stockbrokers, as well as Jatin Gedia, technical research analyst at Mira Asset Sharekhan. Gentlemen, thanks so much for joining us as always, and happy Friday to you. Jatin, I'll come to you first on what you're seeing on the screen. And if you have any existing positions, a lot of people seem to have unwound them and not rolled things over into the new series. But what should your strategy be in this current environment?
Good morning, everyone. Yes, as likely pointed out, the rollovers have been on the lower side as against the 3-month average in both Nifty and Bank Nifty. So going ahead, what we believe is that since the second half of April, we did see a sharp short covering rally in both the Nifty and Bank Nifty. Bank Nifty went to an all-time high. The Nifty, however, is struggling to cross the 24,500 mark, which was the 61.8% retracement level of the entire September to April decline. So 24,500 was a crucial resistance. And now, until and unless 24,500 is not decisively breached on the upside, we believe that there could be some amount of weakness or consolidation going ahead. Now, on the downside, the crucial support levels which are now ready to be tested are 23,870, which was the previous swing high. So, as per the role reversal principle, now 23,870 to 23,800 becomes a very crucial support level for the Bank Nifty, for the Nifty. So, if the Nifty has to, hold on to some sort of this bullish up move that has been happening since the second half of April, then 23,870, 23,800 should be held on, and thereafter we can expect a further up move. So, this down move has come in. But we believe that 23,870, 23,800 will hold on.
Okay, so that's the view with regards to where levels for Nifty 50 are concerned. Our first query for the day is from Siddharth, who's writing in from Pune. He's holding 600 odd shares of Tech Mahindra, bought at 1510 a piece. Sameer, I'll come to you on this one. Tech Mahindra came out with its earnings yesterday. Numbers largely in line. Deal wins were better than what analysts were expecting. But overall, the top 3 segments growth has been largely flat. What is your reading of the earnings, and what should Siddharth do with respect to his holdings right now?
Yeah, so good morning, Mahima. We've been saying for some time that the IT sector is something that we have not had too much comfort with, given the fact that growth is in single digits. Guidance is in single digits for growth. And the best part of the margin expansion that happened over the last couple of years is now behind us. So now we are going to have to maintain at these margins. So when companies are growing at 4-5%, yes, Tech Mahindra had a phenomenal quarter. I will not put that behind because of the cost reduction initiative, and also there were some one-offs. If you take into account, then the growth was not that great. It was good, but it was not as spectacular as the 79% that looks like when you look at the numbers optically. But the basic thing is when companies grow at 4-5% and margin expansion is not possible. So we're talking of profitably growing maybe at 6% or 7% and companies trading at 22 times forward earnings. It becomes difficult to justify why one should invest in the stock. So as good as the numbers were for the last quarter, we don't think growth is going to be anything phenomenal. Order executions are going slow. New orders, even though they're coming, we need to see the light of day. And plus, you also got to remember that if the US is going to go through a slowdown, which everyone's talking about, which is the biggest market for all our IT companies, then you're not going to see good growth because eventually they are going to cut spends from IT. That's the easiest place. I keep saying it's the easiest place to do some amount of cost saving. So if that is the case, then why should we value companies at these valuations? So I'm not in favor of investing in IT at this point. Your caller has bought it at 15.10. If he has a very long-term view, maybe 3 years, he can hold on. But if he's looking at a 1 year kind of view, I think he should exit it and buy something else where the opportunity in the near term might be better.
Okay. So comprehensive view on TechM as well as the IT space. We've got our first caller of the day. Snigdha is calling us from Hyderabad. Hi, Snigdha. How can we help you today?
Hi. So my query is regarding Wilson and Solar.
Sterling and Wilson Solar.
Yeah, Sterling and Wilson Solar. Sorry. Yeah. So I have 600 shares purchased yesterday at 328. So I just want to know if I can hold it for next 3 months or should I sell it?
Okay.
So the results were declared yesterday, right?
Yes, they were. A stock under a little bit of pressure, so I'm guessing that's what you are concerned about. So let me go across to Jatin on the chart. Jatin, under pressure today. In fact, no buyers in the stock. It's currently locked in circuit. So what should you do if you bought at levels of 328 with a relatively short-term time horizon?
I think it's time to exit at a minor loss. The reason being it has hit the 330 mark, which is the 20-week average. So a crucial resistance has been reached, and thereafter we are witnessing selling pressure. I know this selling pressure might last for some days, and the stock can drift towards 285 to 278 levels. So that's a decent down move that we are expecting in the stock. So even if at minor loss at current levels, she should exit the position.
Okay, so that's the view with regards to where charts are concerned for Sterling and Wilson. Our next question is from Yogesh, who's writing in from Bengaluru. He's holding Eternal, that is Zomato. 15,000 shares bought at 238 a piece. The stock is currently trading at 231. So he's sitting on a loss of around 94,000 odd rupees. He wants to know whether he should hold or sell at the current levels. Samir, your view with respect to where fundamentals are concerned for something like a Zomato?
The fundamentals are good, right? The quick commerce business, which is there, obviously is loss-making at the moment. But as they keep scaling up and the operational benefits start coming through, and they can start reducing the discounting, to capture some market share, I think that business of theirs will start turning profitable quite quickly. They've obviously been able to show that, once they want to turn profitable, they can, the way they did with the food delivery business. And that business continues to scale up. We believe the opportunity is only going to increase given the kind of consumption increase we are expecting to happen post these tax cuts that the government has given, which will start now. So if order increases on the food delivery side, that will lead to increased profitability. The QSR space, quick commerce space will also grow. And eventually it'll take maybe a year and a half before they can break even. But given the fact that this is a business which requires limited capital investments, can get the operational efficiencies to kick through. And we've seen that in the past. Maybe 2 years down the line, if the person has a 2-year horizon for waiting, I think he can make good money. So stay invested. In fact, I would go ahead and say that if the stock corrects closer to the 190 levels in this fall, whatever's happening in the markets, go ahead and buy some more.
Go ahead and buy some more is the view coming in on Eternal. And of course, your view, quick view, Samir, Swiggy versus Zomato, preferring Zomato over Swiggy?
So I think Zomato, being the larger player, would probably stand to benefit. Swiggy is also good, but if I had to make a pick, yes, Zomato would be the pick I would make at this point.
All right. So that's the view with regards to where Zomato and Swiggy are concerned. Our next caller, Mansing, is calling in from Andhra Pradesh. Mansing, a very good morning to you. How can we help you?
Good morning, madam. I'm holding Tanla Platforms.
Okay.
60 shares, average price 590, madam.
Okay.
Yesterday it posted results. How was the results? I will hold for 1 year. I want to know the fundamental and the technical view, madam.
Okay. Mansing, Sorry, you were saying something? Okay, I'll take your view, Samir, on this one. Tanla Platforms came out with its earnings yesterday. Well, largely the numbers were flat in terms of revenue growth. It was at 2.4%. EBITDA was down by about 1.5 odd percent. What's the reading like, and what's your view like?
Sorry, unfortunately, Tanla is not a company that we cover. So can you put this to the
Okay, sure. Jatin, on the charts then, do you think this is the right time to make an entry or maybe continue to hold?
I would suggest the caller to wait. The reason being the stock is in a medium-term downtrend, and we believe that on the downside there is still more downside towards 430 to even 400 odd levels. So the stock is in a downtrend until and unless it sustains above 510, 525 odd levels. We don't see the trend reversing as of now. So Tanla solution should be avoided from fresh entry.
Avoid Tanla platform is a view on the charts. Okay, just to follow up then, if that's the case, then if you're holding, would you exit at this point, Jatin?
Yes, I would suggest to exit because the structure that is panning out since the last couple of weeks is not bullish. In fact, it is only suggesting a range-bound price action, and we can expect a breakdown of this consolidation on the downside. So the price pattern is not suggesting a fresh rally on the upside.
Okay, all right. So that's the view on Tanla Platforms. Our next question is on Century Ply, and it's a question from Kadir, who's writing in from Nagpur in Maharashtra, and he's bought at an average price of 370 rupees a piece. He's looking for a fundamental view, long-term view, and he's in the green quite considerably so because the stock is currently trading at 709. What's the view on this one, on the fundamentals, Samir?
So Alex, fundamentals for the company are good. We believe the growth opportunity is quite strong given the kind of boost we are getting in the real estate space, which is what drives the business for this company, right? So yes, temporarily there's been a bit of a slowdown, but we believe we will see the real estate cycle seeing an uptick further. And once that happens, companies like Century Ply and all will continue to do well and do even better. But the problem for me is only one, that the valuations are not attractive at this point of time. The stock is trading at about 40 times 1 year forward. And for me, that kind of is like a threshold where I would not want to be recommending a buy. So if we see a correction in the stock, maybe of 20+%, again, like I said, it needs a significant correction, then it would throw up a buy opportunity for me from the longer term, because like I say, I like to make 15 to 20% return with taking not an excessive amount of risk. And when I'm buying something at 40 times 1 year forward, I believe I'm taking a lot of risk, because if something doesn't pan out the way we expect it to, then the downside opens up quite significantly. So from that perspective, as good as the opportunity for Century Ply, Green Ply, any of these companies is, I would avoid them at this point given the high valuation.
All right. I encourage our viewers to ask all their questions related to investments, and even the basic ones. We've got a question from Nimali Puri, I believe that's the name. How many stocks should you ideally hold in your portfolio? And it's a pretty basic question that somebody would ask when they're looking to venture into the stock market. Even somebody who's tried their hand. I guess, Samir. So this question obviously is for you. And we've spoken about this in the past, right? With a lot of our viewers taking concentrated positions, some of them as much as 70-80% of their portfolio. The question really is, how much should you hold? The immediate response that I gave was whatever you can track. And so if it's more than 20-25, then you're probably not going to be able to track the stocks that you've bought. Is that a fair answer?
So I would agree with you that 2025 should be up to 30 should be the maximum anybody should hold in a portfolio, because it kind of gives you diversification also, and also leaves some amount of concentration. So you can probably split it up where some of the companies where you're more bullish as 5%, and maybe some of the companies where you are not as confident, maybe 2%. In general, if you have 30 stocks, 100% portfolio would be 3%. So you can vary that around a little bit. But in general, yes, 30 companies should be the outer limit. 20 to 25 would be ideal in a portfolio. But let's put it this, if you can only track 20 to 25 companies, and which is why sometimes it makes more sense to give money to the professionals to manage or take advisory services from the professionals, is simply put that there are over 4,000 companies in the market, And sometimes you may not be able to study something or get an idea which somebody else in the market has. I'm not saying that every broker or every advisor also has the same coverage, but at least they have a little bit more because they have more resources on their thing, and this is their focus. But yes, 20 to 25 to answer the question should be ideal. Try not to cross 30, and no point having less than 10 stocks and having concentration of over 10% in each stock. I think that is a bit of a risk.
Yeah, another way to look at it would be to split your investments, to have, of course, mutual fund investments as Samir is talking about, and you can have a kicker. You can have a few stocks that you hold individually as well, things that you might want to pass on to the next generation. All right, Madan is calling us from Bengaluru. Hi, Madan. Thanks so much for calling. How can we help you today?
Yeah, my question is on Dr. Reddy Laboratories.
Yes.
I'm holding 500 stocks of Reddy Laboratories. I had bought it for pre-split. Now I'm holding 500 shares of lesser face value at an average cost of 1,300 rupees. With a lot of talk on this Trump imposing tariffs on Indian pharma also, how is Dr. Reddy is placed? And can I hold the stock for some time or book out the loss?
It's a good question, Madan. So you've been holding for a while, pre-split, of course. And am I right in assuming that you would be willing to hold for the long term?
Yes, I am willing to.
Okay. All right. So, Samir, the question is pretty straightforward, and I think we've addressed this over the course of the last couple of weeks. But then the nature of the announcements coming or the news updates coming in from the US are such that there are knee-jerk reactions. If there is an announcement, then there is a sharp sell-off, even if it is not really feasible for companies in the US, for buyers in the US of pharmaceuticals in particular, to shift supply chains very quickly. It's not going to happen. That's the fact. It cannot happen. It will take at least 3 years, if not more. So from that perspective, would you continue to hold in Dr. Reddy's laboratories?
So short answer is yes, I would continue to hold. And simply put, all the arguments that you only put up, I'm going to use. Yes, you're absolutely right. 3 years is the minimum before you can shift. A lot of the pharma, look, medicines is something that people are going to buy, whether it costs more or less. It doesn't matter. If you need the medicine, you need the medicine. Third, a lot of these medicines in the US go through insurance, and insurance is going to have to bear the brunt of it. It's not going to be Dr. Reddy that bears the brunt of it. And lastly, look, what you said about the knee-jerk reaction, I'll say it will not be as bad because Donald Trump has been saying this repeatedly. So the market has to some extent priced in that this is going to come. So when it comes, I think then it could probably, sell the rumor and buy the news. So it could probably bottom out when he actually makes the announcement, because then the worst is over and then things will start looking up. So I would say continue to hold on. That's the long answer.
Okay, continue to hold. DR is the view coming in where fundamentals are concerned for the company. Our next question is from Akshat, who's writing in from Greater Noida. He's holding 10,000 shares of GMR Power at an average price of 90 rupees per share. The stock is currently trading at 123. So he is sitting on a loss of around 3.4 lakh rupees. Gain of 3 point. Okay, since he's bought it at 90 and the current price of stock is at, I think I'm in Friday mood, certainly, at 123. He's sitting on a profit of 3.4 lakh rupees. He wants to know as to what should be the next course of action for him. Jatin, do you think that he should book partial profits and go ahead and continue to hold some, or what's the view like?
See, as far as technically concerned, definitely some partial profit booking is advised. And I would suggest to keep a trailing stop loss of 116 on the downside. So if 116 on the downside is breached, then we can, further expect a downside towards 100 odd level. So if he is still continuing to hold, then 116 should be the stop loss. However, my advice would be to do some partial profit booking.
And have a good weekend.
Yeah, so book some partial profits and have a good weekend is the takeaway from that. All right, our next caller, Shweta, is calling in from Hyderabad. Shweta, a very good morning to you. How can we help you?
Hi, Mahima. Good morning. Welcome back.
Thank you.
My question is regarding BLS International.
Okay.
I have 125 shares bought at 403 rupees.
Okay.
And I would like to know Tamir's detailed view about this stock. I like how he gives a complete picture of the stock. So I would like to know his review for this.
All right. Shweta, got your query. Samir, I'll come to you. I hope you heard that. BLS International is the counter. What's the view like?
So we do have a positive view on the business of prospects, right? So this is a visa facilitation services that they organize all over the world. They have some operations in India as well, and they have operations. We believe with all of these trade wars increasing, what's going to happen is even getting visas in these countries, and for some countries like the US has already started making it difficult, Canada is making it difficult. The requirement of these services are only going to increase in most of these countries. So the opportunity to grow is quite large. Already we have huge waiting lists in places like India for, so the market is going to keep expanding. You're going to have new centers coming up, and all of these centers are very low cost in nature, in the sense they're all operational costs. There's no fixed cost kind of in nature, because the property is rented, the employees are paid salary. And as the revenue starts flowing through and the operations start breaking even and start making money, I think each of these new centers will add quite significantly. So if you have a 3 to 5 year view, please stay invested. Valuations are not cheap, but corrections, again, closer to maybe 300, 320, I would recommend adding on some more. Fundamentals, very, very good. No problems there.
Okay, all right. So that's a comprehensive view on BLS International. Stock under a tad bit of pressure, but quite a few stocks in the broader markets also under selling pressure right now. I understand, Jatin, that you have to leave us. Thanks so much for joining us this Friday. And as always, have a great weekend. We have to slip into a very quick break. We've got more time on the other side to take more of your questions, so do stay tuned.
That's huge. That is a biggie. It's on.
Gold Plus Clear Glass. Far ho ya near, sab kuch dikhe clear.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
The last 1 month, if you see, the share prices of Lloyds Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong,
right,
and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish
Welcome back. You're watching Ask Profit. Now, this show, of course, gets you answers to all of your stock-related questions. But the next one, Know Your Company, helps you understand the stocks that you might be invested in or you might be contemplating investing in. And we've covered a number of companies over the last few weeks. On today's show, we've got Tamilnad Mercantile Bank. And you know for a fact that the last couple of weeks have been incredible for the banking space as a whole. Of course, today and yesterday, you're seeing a little bit of profit being taken off the table. Tamilnad Mercantile Bank is a relatively small bank and it just posted its Q4 numbers not too long back. A decent set of numbers. The question is whether or not the offtake in loans is fast enough and whether the outlook for the next financial year is better than what occurred in the fourth quarter, whether loan growth will finally start picking up. You'll find out what the bank is exposed to in terms of its loan book. You'll find out what its deposit franchise is doing and all of the key metrics in terms of return on assets as well as net interest margins. We'll discuss the trajectory of all of those aspects as well as speak to the management. You should watch out for that at 11:30. Let's take our next caller. I believe we've got a caller, if I'm not mistaken, and I thought it was on data patterns. I think somebody's called us. Yeah, Sampath is calling us from Bhubaneswar. Hi Sampath, good morning. Please go ahead with your question.
Actually, this query regarding data patterns, I'm holding 20 scripts of that stock at an average of 2,598.
Okay.
And currently I'm sitting at a loss of 10K. And since this is a defense sector stock and it has been off recently, it has been under SEBI surveillance for exceeding its valuation. So my query is whether I should hold or should I exit?
Okay, so you got a relatively shorter term view on the stock, is that right?
Right.
Okay. So I'm joined by Vikas Jain on this side of the break. He's the head of research at Reliance Securities. Vikas, thanks so much for joining in. What's the view on data patterns for the short term? Would you book?
Yeah, if he is bought with a short-term perspective, then it is a good exit point. Because if you look at, he has not averaged it at the way below when the stock hit near to those 1300, 1400 levels. And from 1400, the stock has rallied almost near to 2100. So good 45-50% up move has been happened into the lean. And the stock is near to its 200-day average resistance area. So I believe it should put some out that over at current levels and wait for some more decline to enter into the lane back to near to 1750, 1800.
With regards to where charts are concerned for data patterns, our next question is from Aniket, who's writing in from Karnataka. He's entered Lemon Tree Hotels at the price of 139 rupees. He's bought 50 shares and wants to know as to what's the next course of action for this particular counter. Samir, I'll come to you. Your view on Lemon Tree as well as the entire hotel space. Which counters do you like, and is Lemon Tree one of those?
Lemon Tree is definitely a good operation business. The hotel business, we believe, in India is going to keep growing because tourism from within the domestic markets and also international tourist coming is going to keep growing. So we expect occupancy rates to remain high in these properties. The hotel ARRs, that's the average room rates, are also holding firm. So that is a big positive. And you look, most of these companies are now working through the low-cost operational business, which is where they do management contracts. They brand the hotel up in their name. They're running the show, but they don't own the asset necessarily. The asset is owned by somebody else who's happy to earn a 10% or 11% return on that because they get the capital appreciation along with it. So so what happens is when you have a low cost operational margin business, your ROEs can keep moving up and you can expand a lot faster. So we believe Lemon Tree is also one of those companies that is doing that. So it's looking good. It is a long-term buy, even at this price point. Our top pick, of course, in the space would remain Indian Hotels, from the fact that they are the biggest brand and largest. They have presence across all verticals, from the very high premium to all the way down to the Ginger Hotels, which they're scaling up at a very fast pace, which is a low-cost business model. So that remains there. And I'm going to go out and say one offbeat stock, which is generally not discussed in the hotel space, which is a company called Sayaji Hotels. Disclaimer, we own it. And what is the beauty of Sayaji Hotels is, apart from increasing the hotels, right now they're about 21, they're trying to scale up to 31 by the end of this year. It may not happen at the end of this year, but let's assume they can scale that up. That will do well. And they own Barbecue Nation. So they are the promoting entity of Barbecue Nation, where they own about 31-32%. And if you just take the value of the holding of Barbecue Nation, you're getting more than the market cap of Sayaji itself. So just the investment is worth more. And then the hotel business is going to be growing, scaling up, and becoming even more profitable. So we think there's a lot of value in this company. And this stock could probably run up closer to 450, 500. It's come down from those levels, so it can quickly run up to that once you have stability in the markets.
Interesting. Okay. So, Sayaji Hotel, we were just pulling it up, 500 crore market capitalization company, relatively small, but several options available now in the space to pick and choose from. So, bear that in mind. Of course, we tend to speak about the larger ones, Indian Hotels, Lemon Tree, but there are other options available as well. Earnings that came through earlier, not today, but yesterday, Laurus Labs, and Sunil is writing in from Visakhapatnam. The stock under pressure today, 5.7% down. The question, Vikas, is should he purchase at this point? Is this the right moment?
I think we should wait for some more time, because you believe the Laurus Labs always witnessed strong amount of volatility post the result season. And when the stock corrects, it corrects more than 10, 12, 15% at a trot. So we believe on the downside, some amount of support area is near to 570, 575 levels. So we can wait on for those 575 levels, and 10 to 12% correction could happen, which is the intraday average. So that should be a good entry point to enter.
Okay, so that's the view with regards to Laurus Labs. Our next caller, Ravi, is calling in from Hyderabad. Ravi, a very good morning to you. How can we help you?
Yeah, very good morning. My query is on Bajaj Housing Finance. So is it a good time to buy Bajaj Housing Finance, or shall I wait for a couple of days so that the stock gets more correction?
Okay, and Ravi, when you say you want to buy, is it the time horizon is longer term from a longer term perspective, or?
Yes, I can hold for 1 to 2 years.
1 to 2 years. Okay, Samir, your view with regards to Bajaj Housing Finance, is this the right time to buy?
Quality asset pricing is a little bit expensive. I mean, but look, all the Bajaj finance companies, that is Sanjeev Bajaj Group companies, have been trading at premium valuations for some time. So that makes me believe that probably that's a premium valuation for Bajaj Housing Finance can also sustain. But I mean, since the question is about Bajaj Housing Finance, I say yes, you can go out and buy. But I think there are other companies in the housing finance space which are more attractive at this point of time and may warrant a better buying opportunity. I'll give you one which we are very, very positive on, is Sammaan Capital, which used to be the erstwhile Indiabulls Housing Finance. It's trading at under book value. They've gone through the pain of cleaning up their books. They've taken huge provision. The split in the company has happened for the affordable housing as well as for the premium housing. They're going to be working the model where they do co-lending. So 20%, we've discussed this on your channel, 20% will be funded by them, 80% by another person, meaning a bank, and they will be able to charge a fee to the bank for the collections, for all of the activities that go on. So their ROEs will move up quite a bit. And as the ROEs move up and as the operational efficiency kicks through, I think Sammaan could probably a stock that could go closer to 200. So that would be my top pick in the space at the moment in housing finance. But Bajaj Housing Finance is also a good investment.
Okay, all right. So watch out for Sammaan Capital. The entire pack, in fact, quite a few stocks are trading in the red at this juncture. Tata Motors. So this is a question from Leena, who's writing in from Kolkata, and she's pointing out that she's tracking the company. She's looked at the fact that a demerger is on the cards. She's looking for a potential target from the perspective of 12 months. And Samir, that overhang for Jaguar Land Rover and the US tariffs, all of that has weighed on the stock, and it's trading at what, 660 or thereabouts, if I'm not mistaken, on the ticker. Is this a good moment to buy? Because I don't know how many opportunities you'll get to get Tata Motors at, I don't know whether it'll go back to COVID lows. Double digits was when it hit then. A lot of people jumped into it, benefited from that. Would you buy right now, Tata Motors?
So I can safely tell you, Alex, that it will not go back to the double-digit number ever. So that was an opportunity. It was a once-in-a-lifetime. Is this also a once-in-a-lifetime opportunity where the stock has corrected down from 1100 to 600? I would like to say yes, from the simple point of view that the opportunity in India continues to remain very large for the Indian domestic market, which is of course a big chunk of their business also. The profitable chunk of their business is Jaguar Land Rover, which we believe will return to normalcy. And it's not only Jaguar Land Rover. When these US tariffs and all of these things impact, it impacts all the other car companies as well. So it's not going to be just Jaguar Land Rover that suffers or struggles. It's going to be everyone, or everyone together figures out a way, including the US government, how they can allow these cars and imports to happen, because you cannot expect everyone to set up manufacturing within the US. There will be selected few that do it. Maybe some offset kind of things can happen, but you cannot expect every single company to do it, and they have to realize that. So unless they want to just increase their costs, like we in India pay unnecessarily high amounts of import duty on cars. I mean, if US does that, that's really bad, and that could hurt like Jaguar Land Rover, but we think it'll settle itself out. And from a growth perspective, we think the opportunity is there. So I think, yes, go ahead and buy Jaguar Land Rover. Valuations optically may seem a little expensive, but they're not. We think the operational efficiencies from the India business will start kicking in, the profitability increase, and which we've always discussed before, there's going to be a demerger, which is going to lead to some value unlocking that's going to happen, where they're going to split up the commercial vehicle business and the passenger vehicle business. So once that happens, I think the commercial vehicle business can get similar valuations like an Ashok Leyland or somebody else like that. And the private vehicle business can also start commanding some valuations more like Maruti. If that starts happening, that will itself will lead to a uptick in both the counters. So we think it is a buying opportunity at this point.
Right. I was just speaking to Alex that our auto analyst is going to be very happy about this, because we keep sharing memes about how loyal investors have always stayed invested in Tata Motors no matter what.
No, but I know also people that have gotten in at those double-digit levels and they booked out at. I know somebody who bought a house. Of course, you need to be able to, but you need to be able to deploy that much. We have some of our viewers who've got that kind of capital, sitting on gains of 1 crore plus or 3 crores for one individual. You're talking about which company today? You remember we got a call for DB Realty. It's called Valor Estates now. Yes. And what a run it's had, right? He's sitting on 3 crore gains. And he mentioned very clearly, I can't remember his name, but he mentioned very clearly that he's going to hold on to it, even though it's 50% of its portfolio.
Yeah.
So we have viewers like that.
Yeah, absolutely. Yeah. All right, our next caller, Soma Shekhar, is calling in from Bengaluru. Soma, a very good morning to you. How can we help you?
Yeah, good morning. I'm Som Shekhar from Bengaluru, short-term trader. Okay. I need advice on buying BHEL because it has come down, whether it's the right time to buy it.
Okay, I'll take this up with Vikas. Vikas, for BHEL, what do you think? Are the charts indicating a buy right now?
Yeah, the stock has witnessed some 5% correction along with the broader markets. And now it is been at near to support area of 115 to 118 levels, which is a band of the averages. No doubt there was some amount of negative news flow for fire without it one of its plant. But the stock has not reacted through. So with this major broader market corrective action and the stock down by 4%, it gives a good opportunity to own the name. So we can invest near to those 215 to 118 levels. On the higher side, the first immediate target will be near to 240 to 45, which is the 200-day average.
All right. So the next question is from Revati, who's writing in from Madanapalli and asking about Waaree Energies, bought during the IPO and trading with gains at this juncture. And well, it's down about 3%, but it moved quite dramatically over the course of the last couple of days. The question is about valuations and where they're whether they're a little stretched at this point. Some people definitely think so. Samir, I'm wondering whether you are one of them.
Yes, unfortunately, I think the valuations are a little stretched. Look, what's happened is they've had a phenomenal year this year because of the growth of the new capacities that came on. Now that is not going to keep repeating. So when I'm just giving you a simple example, when you go from say 4 million to 8 million, you're doubling yourself, right? So you have huge growth opportunity that comes up in the top line and the profitability because of the operational leverage. Now I'm not denying when you go from 8 to 12 also, the operating leverage is still there, but the growth is not 100% anymore. It's come down to 50%. And now Wari is sitting on quite a large base, right? So whatever further expansions they're going to be doing, yes, it's going to be meaningful, but it's not going to be as meaningful as before. So growth is not going to look as strong. And then you're not going to see the profits growing as much. So then the premium valuations of about 45 times current year earnings seems a bit expensive. We believe but actually, if you go look at it, everyone is trading around similar levels, be it Suzlon, be it KPI Green, be it Sterling and Wilson. You can't really take the valuation because they've just about turned into profits this year, and the operational leverage is still to play out. But they're all trading at this. But the point is that Vari Energies also makes these solar cells, which they export. And US, there are two things. One, the import duty that's come, that's going to hurt them a little bit. Is it going to benefit because China is paying more? Probably in the short term, yes. But what is also, second thing that's happened is Donald Trump is not pushing renewable energy in the same way that the Democrats were. So what is going to happen if incentives for setting up renewable energy from the US government go down and that growth does not happen in the same manner, then Vari can see some amount of lower growth in volumes, and that could also affect. So I'm not as convinced on a Vari Energy at this point of time. If you want to make a play in the solar energy space, the two stocks that we are invested in and we like, one is KPI Green, which sets up the solar parks within India for themselves through IPP and CPPs for other customers as well. And there's Sterling and Wilson Solar, which is part of the Reliance Group. There was a question in the show earlier of whether you should hold on. Fundamentally, I'm very convinced that the quarterly numbers that came were very good. The top line showed growth. Their order book is at 9,000 crores. We believe they will be able to do well over the next couple of years. Yet we haven't seen any real orders coming in from the Reliance stable. Once Reliance places orders for their solar plants, I think the opportunity, their growth numbers will see further acceleration. The operating leverage is coming through, and you're getting the stock at a very reasonable price. This is a stock that traded at 800 rupees, which is down to about 310 right now, and had gone down to 220. So this is a chance to buy into a long-term investment. Yes, short-term, you might see volatility, you might see the stock going down again to 280. But for me, these are the two plays that we would make in the green energy space at this point.
Sterling and Wilson at lower circuit at this juncture. Samir, there's a very insistent crow outside your window that seems to be very happy to join us on today's program. Okay, let me take the next caller. Murli is calling us from Bengaluru. Hi Murli, how can we help you today?
Good morning, and thank you for taking up my query.
My pleasure.
Yeah, I bought Canfin Homes, 500 shares,
yes,
at 745 for 799 rupees.
Right.
Now, in spite of good results, I don't know why it is coming down. Not generally market trend, even otherwise it was coming down. In spite of highest ever quarterly profit, all under control.
Yeah.
Can I switch over? Can I retain, continue to hold, or switch over to Canara Bank?
Canara Bank. All right. And you've got a long-term view on this one, Murli?
Yeah.
Okay. It's an interesting question. All right. We did look at the numbers. Canfin Homes, Samir, since this is a fundamental question, coming back to you, numbers weren't bad. My only question is, while the entire system is seeing a little bit of an anemic kind of a loan growth phase, in that context, there are a couple of entities that are growing faster than others. We already discussed Bajaj Housing Finance, but then valuations are a bit maybe uncomfortable for a few people. In that context, Canfin Homes was being suggested as a top pick by a few brokerages. I don't know what you think. 799 is a buy price. Would you switch over to something like a Canara Bank?
So that, look, if you're buying Canara Bank is not exactly a only pure securitized lending business. It has banking operations and all of that, which I always prefer from growth opportunity because they have multiple sectors to look at, and they can ensure that if one segment, for example, I'm just giving, say, housing were to slow down, they can focus on other spaces to grow their loan book. Whereas a Canfin Homes has to focus on the housing and then maybe even look at, to increase their spread because it's a very competitive space. Look at giving developer loans, and developer loans is where the big pain point lies. So if you're asking between a switch, Canada Bank is obviously a better bet than a Canfin Homes at this point of time. But housing finance is a very secure portfolio. So that is the beauty of it. As Canfin Homes has been able to grow at a very decent pace and been profitable over this growth. They really haven't had too many hiccups. They maybe had one maybe in the last 3 years, if I can remember. But barring which, I think they've had a very relatively clean go ahead. Whereas LIC Housing Finance has also been growing, but in a similar, it's again a PSU kind of housing finance company, but they've had more hiccups along the way with certain corporates turning default or certain developer loans not working, their margins not being able to maintain over a period of time. They've been having fluctuations. So Canfin has actually done a very good job. So if you want to stay invested, I think you can stay invested from a housing if you are looking at a pure housing finance. If you are not hell-bent on a housing finance, then you can obviously look at Canara Bank because I think banking operations are great and they can scale up quite quickly. So the call eventually has to be what you want to do. But yes, Canfin is a good hold-on opportunity if you have interest in housing finance.
Okay, that's a comprehensive view on Canfin Homes. Thank you for that, Samir. Our next caller, Suresh, is calling in from Hyderabad. Suresh, a very good morning to you. I believe you have a question on Nalco.
Yes, I'm holding around 300 shares on at 163.
Okay.
So I'm in loss. Just I wanted to know whether a short term and long term view for this Nalco. Short term within 1 or 2 months and long term is more than a year.
Okay, I'll take this up with Vikas. Vikas, what are the charts indicating for something like a Nalco? He's sitting on a loss of around 2,000 odd rupees right now. What's the view like?
Can continue to hold on because it is almost near to its purchase price. No doubt with the broader market correction, today the stock is facing some amount of pressure. But we believe the stock has the potential to move higher near to 180, 184 levels over the next 2 to 3 months for the time he's been holding through. There is some amount of good support area near to 148, 149 which should hold on. So we can continue to hold for a target of 180 or levels.
I'm coming back to you on this next one, which is on Lloyds Engineering Works, and we've got Viresh from Bengaluru who's asking this. He's bought at levels of 66.83, 1,493 shares, and it's just about where the market price is. So would you hold or sell?
In terms of Lloyds Engineering, nothing substantially looks like from current levels. So we believe we can exit and wait for some more opportunity in the broader market, corrective action, what has been taking place through. Because the stock has also multiple bound of resistances near to 70, 73 or band. And it has been moved up sharply higher from those 40, 45 base levels. So the risk to reward ratio would not be favorable.
Okay, so that's with regards to where charts are concerned for Lloyds Engineering. Our next caller, Siddharth, is calling in from Andhra Pradesh. Siddharth, a very good morning to you. How can we help you?
Very good morning, madam.
Go ahead with the query. Yeah.
Tejas Network 900. Tejas Network, madam.
Okay.
My query regarding Tejas Network.
Okay.
I'm holding 100 shares, average price 98, madam.
Okay.
Today it will post results, sir. It is nearer to support zone. Should I accumulate more shares right this level?
Okay.
Is it right strategy? My investment horizon 2 to 3 years, sir.
2 to 3 years. Okay. All right.
It's showing good center with the volumes, madam.
Okay.
So, right strategy to accumulate now.
Okay, got your point, Siddharth. I'll take this up quickly with Vikas. Vikas, with respect to the charts, Tejas Networks, is this a good time to add?
Yeah, you can certainly do so because if you look at the stock has witnessed good rebound from the lower part of the range of those 750, 780 levels with huge amount of volume and price action. No doubt the stock made a recent high of around 960, 980 and from there again the stock has declined. So it's near to the support area of those 50-day averages and of 30% retracement of the entire move. So it's a good entry point to enter. As he has a long-term view of 1.5 years, we believe the stock should have the potential to move higher to 1050 to 1080 levels. So we can invest.
Okay. All right. So it's time now to hit the rapid fire segment. Gentlemen, you know what this means. We'll throw as many questions at you over the course of 2 minutes. And we request you to keep your answers as quick and cogent as possible. The first question is on Yatharth Hospital with a longer term view, and this is for the period of 5 years. 400 is the level that Bikram has bought. Would you hold? What's the view on the fundamentals, Samir?
No view, no coverage.
All right, SBI is the next counter. Tushar from Bhopal is asking whether this is the right time to enter the counter or not. Vikas, your view on the charts?
Yes, certainly you can do so. A good entry point after this correction of 4% from the recent high.
Okay. Can Indian hotels be bought at this price? Gul has already bought at levels of 752. Would you add more the current price, Samir?
Yes, you can add.
Okay, Bajaj Finance is the next counter. Siddharth M has bought 3 shares yesterday. What's the view like on the charts, Vikas?
Some weakness to be persist would hit 8800 to 8750 over the next few days.
Okay. Sami Hotels, I know we've spoken about another hotel, but would you pick this one? If you bought already at 194, 3,000 shares, would you hold on, buy more? What's the view? Samir?
I think you can hold on to Sami. It's also a good investment. I mean, good company doing well.
Okay, LTI Mindtree is the next counter. Aditya from Pune has bought 50 shares. He wants to know whether he should book loss or keep holding. Vikas, on the charts?
The IT sector is being completely oversold and showing some amount of strength in these falling markets. The results have been out, so the price volatility would not be there, so we can hold.
Anant Raj bought at a price of 564. Surya wants to know if you want to hold for 2 to 3 years, would you continue to hold, Samir?
I would say go out and add some as well.
Okay, Maharashtra Bank is the next counter. Darshan wants to know whether he should go ahead and buy it before the results are announced. Samir, your view?
Not the top pick in my banking space, so no, I would not.
Okay, coming back, CESC, we've got Rakhi who's got 50 shares. I do not know the buy price. Would you hold, Samir?
Yes, hold on.
Okay, all right. We're out of time on the rapid fire segment. We've covered quite a few stocks on that round as well as over the course of the show. Gentlemen, thanks so much as always for taking the time. Pleasure having you.
Thank you, Alex. Thank you, man.
All right, that brings us to the end of this edition of Ask Profit. As always, it's been an absolute pleasure from myself and Mahima and the team that put the show together. Thank you so much for watching. Up next, as we've pointed out, is Know Your Company, so do stay tuned.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
In the last 1 month, if you see, the share prices of Lloyds Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the
Today on KYC, we have a bank which has an ROA of 1.8%, but is available at 0.8 times price to book. That's why it's interesting, and that's why we've taken up Tamilnad Mercantile Bank. The stock was up yesterday on the back of numbers, and this is why it's a proposition which we are considering on KYC today. Is this really a proposition that you want to take a bite of? And that's what we'll try to get perspective on. Growth concerns, well, this is where there's been a bit of a challenge, at least over the last few years. Should we continue to be worried is really the question, and we'll quiz management on this, and try and get perspective. And last off is with regard to the general downside risks that banks have. One is with regard to margins. Second is therefore where to expect ROA to come from. If the current ROA is 1.8%, if that ROA were to fall, will it dramatically change things with regard to the bank and asset quality? How comfortable is the bank with regard to that? So we'll speak about all of that and try and get perspective. But let's first take a look at what the bank has in terms of the past history, as well as what it does in terms of its lending. And I'm going to start off with a little bit of background with regard to the bank. It was founded as Nadar Bank in 1921, opened to the public on November 11th, 1921, renamed Tamilnad Mercantile Bank on 27th November 1962. It had 4 branches in 1947 in Tamil Nadu, became an early adopter of technology in 1984, introducing ATMs in 2003. It operates 578 branches currently across India, and has a branch and has an ATM network of around 1157 ATMs. It also has 358 cash recycling machines. So that's just some perspective on the size and the type of bank that we're looking at. In terms of loan portfolio, it's into retail, agri, MSME, and a lot of this is actually corporate. And this is all INR crore. That's how it stacks up. In terms of the size of the book, not too large. It's just about 45,000 crore in terms of book size, around 6,000 crore in terms of market capitalization. So that's broadly how this one stacks up. Let's look at and let's break this up into percentages if we can. Retail is around 21%, agri is around 42%, MSME is around 31%, and 7% is others, which is largely the corporate book. So retail, agri, MSME, largely focused. 93% of the book is concentrated on retail, agri, and MSME. Let's try and break the NPAs up as well on each of those. Look at the NPA ratios in terms of asset quality on each of those. MSME is 1.54, but really others is where the pain has been, and that's just 7 to 8% of the book now. What are they going to do with the corporate book is the other piece I would want to know. when we speak with management, and we'll quiz them on that count as well. But let's look at the metrics that we'll look for, and we'll speak with Mr. Sally S. Nair, who's the MD and the CEO since August of 2024. He's taken charge of Tamilnad Mercantile Bank. A few changes as well he's made with regard to processes on the lending side of things and strategy as well. And we'll quiz him with regard to all of that. Let's quickly look at the metrics that we'll be tracking today on Tamilnad Mercantile. We look at income statement, balance sheet. We look at operational metrics, asset quality, return ratios, shareholding, street cred, and valuations. We'll try and break Tamilnad Mercantile on each of these metrics. Let's start off with the income statement. And mind you, it's a small bank in relative terms. And therefore, in terms of size, given that it's small, you would expect that it grows at a faster clip. So let's look at the income statement, see whether they've been doing that. They've been growing net interest income at just about 8% 3-year CAGR. So not impressive. 5% on operating profit and around 13% on profit after tax. The 13% on PAT doesn't look as bad, but compared to the single-digit growth in net interest income, that's a lot of that profit after tax is also coming from the lower provisions number. The provisions number has gone down from around 700 crore in FY22 to just 171 crore in FY25. So it's the lowering of credit costs which has led to that profitability spike. But when you're looking at the overall growth numbers, if you can pull those numbers back up, it's just about single digit with regard to top line, which is net interest income. And that is not very, very, lucrative from a growth perspective, given that the size of the bank is extremely small. So an 8% growth, 3-year CAGR, well, doesn't look impressive at all. We've given this a thumbs down, therefore. Let's look at the balance sheet, though. And in terms of balance sheet metrics, we've seen gross advances go up by around 10% on a year-on-year basis. Deposits is up 6% and CASA is up just about 1% or so. So that's how it stacks up. Again, from a balance sheet growth perspective, not looking extremely lucrative. You want better growth from a bank of this size. So we'll quiz them on a couple of these factors. Largely, what we are seeing, therefore, is slow growth with regard to how this bank is playing out. And that's where the worry or the concern is. Let's look at key ratios, though. Let's look at yield on loans. We've seen a bit of an inch up versus FY23 in FY25. So we've seen some of those metrics get a little better. Cost of deposits also we've seen an inch up and expected, right? We've seen the repo rate go up all the way to FY25. Now we've started to see a taper. So we'll start to see some of those metrics play out as well. Net interest margins, we've seen a taper down, understandable again. Cost to income ratio is actually between the 42 to 45% mark. So largely in line. When I'm judging Tamilnad on the basis of margins as well, it's not a very bad margin number. You've got peers which are doing 3.5%, something like a DCB bank is doing maybe 3.7%, a City Union Bank as well. And then you have certain peers which are doing higher margin. So I wouldn't be too concerned with that margin number of Tamilnad. I'd call that a thumbs up for sure. But essentially, it's the ROA number which governs all of these metrics, and it all comes together with that ROA. And look at the ROA, it's been fairly steady in that sense. You look at the ROA for FY23, it's at 1.97%, FY24 is at 1.84%, and FY25 is at 1.88%. So fairly steady ROA. Even within FY25, the last 3 quarters, you can see on your screen, 1.94, 1.89, 1.88. So fairly steady with regard to where the ROA metric is. So clearly a thumbs up with regard to the ratios that it's clocking, both in terms of margins as well as ROA. But what I want to see is growth along with this ROA. If that were to get balanced, things would change quite dramatically with regard to this bank. Let's look at asset quality, because that's the other metric that one would want to look for. One is the operational side of things, one is the asset quality side of things. And you're seeing a steady performance in terms of GNPAs, at least over the last 3 years, even net NPA ratios fairly steady over the last 3 years. So both of those metrics doing well. We'll give this one a thumbs up as well. Let's look at return ratios now, because when you're looking at a bank, your return ratios of course matter. So from 15% in FY22 and FY23, return ratios have fallen to around 12.5% in FY24 and FY25. I would believe that some part of that would be because there is no growth coming through. If growth were to kick through, you could likely see return on capital also improve substantially with regard to where this bank is. So something to look out for is that growth number for sure. But nonetheless, we'll give this a neutral, given the fact that you're still clocking an early teen kind of return ratio, nearly an early teen. And if growth were to come back, you could see an uptick in terms of return on capital. So which is clearly going to be a positive if it were to play out. Now let's look at shareholding pattern. Now generally in banks, you might have a promoter or two holding maybe 15% or maybe 20%, 25%, depending on how the RBI has enabled that ownership. Or you may have a large set of institutions holding small chunks of the bank. In this, it's neither. There's a public holding which is large, around 94%. Outside of that, its FIs, DIs dominated. And therefore, we'll give this a thumbs down because there could be some bit of drag with regard to where the shareholding is. No large ownership owned by any one set of individuals or parties, and therefore something to look out for. Let's look at street cred now. It's a recently listed bank. It's listed at around 525 rupees. That was the IPO price. Thereafter, currently, the stock price is at 450. So not looking too good from a shareholder return perspective from an IPO standpoint. Even now, you've got really muted returns coming through last 3 months, 6 months, etc. But nonetheless, we've not seen this get beaten down in a significant fashion over the last 6 months. Mind you, small and mid caps have really faced pressure, but the stock is up 8% in the last 6 months. So it's a fairly balanced setup in that sense. You're not seeing too many large downsides to this where the stock price performance is concerned, while we're not even seeing very large upsides. So we'll give this a neutral for now, while IPO holders will still be holding the stock, and therefore you might believe that you've not got any returns whatsoever, but also you've not seen too many downsides to what you've seen, and therefore we'll give this a neutral, at least with regard to street cred. Now to the most interesting part with regard to valuations. Let's quickly look at that, and why is it interesting? Because let's first look at the journey of the book value per share. As you can see, from 321, it's gone to 374, which is roughly a 54 rupee EPS. From there, it's gone to 437. From there, it's gone to 500. Now it's sitting at 569, right? That's how the EPS journey has been for Tamilnad Mercantile Bank, and how the book value journey has been. The current market price of this stock is 450 rupees. So it's trading at 0.78 times price to book trailing 12 months. What we've done is we've assumed that the same EPS will continue for next year as well, FY26. Mind you, there's no analyst coverage here, so we've had to rely on some bit of judgment and some bit of what management has said over the last few quarters as well. And of course, we'll get management commentary coming through to you as well. So a couple of those factors is what we've built into our assumptions. Let's assume the FY26 EPS to be at rupees 75 and no growth in EPS between FY25 and FY26. In that case, your FY26, which is your 1 year forward price to book, is 0.7 times. That's super cheap for a bank with an NPA ratio, if we can pull those ratios up with regard to NPAs and asset quality. If you look at the NPA ratios, they've been fairly controlled. Your gross NPA has been below 1.5% for the last 3 financial years. Your net NPA has been below 0.9% for the last 3 financial years. So for that kind of a setup to be valued at 0.7 times 1 year forward, it looks slightly anomalistic, and therefore we're going to give this a thumbs up because valuations definitely supporting the kind of play that's happening with regard to this bank. You may want to have a look at that as well. But you know what we're going to do? We're going to understand this better. But before that, let's quickly look at our KYC ratings and we'll break it all up. We had a thumbs down with regard to the income statement. Why? No growth. Balance sheet as well, very, very slow growth. Remember, it was just 9.5% 3-year CAGR on the loans and advances that this bank has. The operating metrics were quite positive, 4% plus on margins. Asset quality as well was holding up fairly well, at least over the last 3 years. So we'll give it a +1 or rather a thumbs up with regard to both of those metrics. Return ratios, we'll give it a neutral because from 15% they've come down to 12.5%, can inch up if growth were to come back. We'll also give a thumbs down to shareholding because largely held by public shareholding. Street cred, we're going to give this a neutral, and valuations, we've given it a thumbs up as well, and we've explained that metric and our assumptions within that valuation metric, and we've given this a 4.5 on 8, Tamilnad Mercantile Bank. But can some of those metrics change? Can there be a positive bias? And what could the downside risks be? Let's try and understand that a little bit better. We have Sally S. Nair, who's the MD and CEO at Tamilnad Mercantile Bank, joining us. You know, Mr. Nair, I'm going to start off with the key concern for me at least. The last 3 years, advances and deposit growth CAGR is just about single digit. Can that change? Can that improve? And what's the likelihood of that?
Yeah, thank you. It's indeed a pleasure to talk to you today. Yes, Tamil Nadu Mercantile Bank's growth has been muted both on the deposit side and the advances side in the last few years. But I think that's a trend that we are trying to arrest. A lot of initiatives have been taken. And if you look at the results of FY25, which I'm sure we will talk in a little more detail, it sort of reflects the kind of initiative that we have taken. On the deposits front, we have doubled what we had in previous year. On the advances front, we've almost doubled. Right? If I look at the numbers, in FY24, the growth in deposits was 3.66%. And in the current year, the year under scrutiny, FY25, it is 8.43, more than doubled. And the advances from 6.35% the previous year to 11%. So we are not still there, but we are almost getting ourselves aligned to the market. And the initiatives that we have taken, like I said, is going to bear fruit. It will take, I think, another couple of quarters for it to bear fruit. We have taken a number of initiatives to sort of kickstart the growth, to move the needle up, to generate the kind of profits that we are looking for, that we are entitled to. I think it will take a couple of more quarters. But you notice the numbers that we have delivered in FY25 itself is beginning to be aligned to the market. And I expect in FY26 going forward, it would be fully aligned with the market, perhaps even a tad better than the market. That's my reading of the return from the initiative that we are taking.
Got it. So where will the growth number lie in FY26 therefore?
See, FY26, as I see it, is going to be a year of a bit of a disruption for us because the number of initiatives that we have taken is resetting the bank into a growth trajectory. You know, change is never easy. But despite that, I expect the growth in the current year to be somewhere in the 13 to 14% range.
Okay. And where will the growth come from? Where would the loan mix be at? How would there be any major shifts to that?
If you notice the FY25 numbers, I think our RAM, the retail, agri, and the MSME sector is at 93%. I don't know if you go back in history of the bank, we did we did have a sizable corporate book where we took a serious hit. And thereafter, we changed course and we have been looking at the RAM portfolio, and that's where consciously we have been growing, and that's reflecting in the numbers. In fact, in FY24 we were at 91%. We have moved up to 93% on the RAM. So total portfolio, the RAM share is now 93%. So that shows the kind of focus that we have. It's not that we will not be getting into the corporate sector back, but that will be in a very, very limited way. After, like I said, the initiatives that we have put in place, the risks, the appraisal system, the risk management practices that we are putting in place, after it takes root, we will maybe look at a corporate book in a limited way. But at the moment, the focus would continue on the retail, agri, and the MSME sector. The retail would be a focus, and the MSME would be the other focus. To just mention that we have just started a credit management center. We are sort of centralizing the credit delivery and the credit appraisal systems in the bank. And I think the focus there is going to be the retail and MSME in a large way, and agri in a limited way. Yeah, that will continue to be our focus.
Point taken. Your yields, sir, haven't gone up substantially. When I'm looking at it, FY22 versus FY25, not seeing that very sharp movement that we've seen versus how the repo has gone up, and now of course we are starting to come back down. So where should we expect that yield number to be at, and just explain this phenomena to us?
The yield, if you look at the yield, I think the yield has slightly moderated in FY25, and yield on the advances, and perhaps the cost of deposits may not have moderated to that extent. So one of the reasons why we see a bit of a moderation happening on the net interest margin. Like I said, the kind of portfolio that the TMP was managing earlier, slight ticket size was a challenge. We were on the lower side of it. We are trying to ramp up the ticket size on the MSME particularly. But when you look at the ticket size, moving up the ticket size, and when we are looking at sort of improving the quality of the portfolio per se, and if you look at the GNPA numbers, if you look at the overall stress numbers, you will realize very clearly that we have delivered some of the best numbers in the market. So when we start, ramping up the quality of the portfolio and aligning the prices to the market, we anticipate a bit of an yield sacrifice there, and we are fully prepared for it. And I think, having said that, in FY26, we would still be defending a 3.80 kind of net interest margin. I find the yield on the advances going down marginally, and despite the rate cut, the deposit yield may not move down to that extent. I'm looking at a deposit cost of deposits in the 5.9 to 6% range in the current in FY26, not significantly going down. We'll see how the rate cuts take shape, but we will certainly see that the NIM in the 3.8 to 3.90 range is sort of defended for us.
What gives you that confidence, sir? Because you will see a downtick with regard to your yields, and you won't see a downtick with regard to cost of deposits. So what's giving you that confidence?
One, of course, is the CASA that I just mentioned about, the initiative that we have put in place, and the kind of strategies that we have sort of initiated in the month of April itself for the year. We are looking at a CASA growth in percentage terms at least 1.5 times of our the term deposit growth. I think that's the kind of call that we have given to our ground force, that to ramp up the CASA, and of course the ground force is also being put in place to support that. So that should help us in moderating, in sort of ramping up the low-cost funds, and giving us some kind of a leeway to keep it at 5.9. I'm also mindful that the industry industry itself is having a bit of a challenge in getting the deposit. So 5.9, I think, is something that we were hoping to sort of steer the bank towards in terms of cost of deposits. But when on the other side, yes, I think there will be a bit of a moderation on the MSME, particularly as we ramp up the portfolio. But we also have a significant jewel loan now. 40% of our asset side continues to be jewel loan. Jewel loan will also continue to grow in tandem with what we are expecting in the MSME and the retail side. There we expect some kind of a I don't think yields there are going to go down as the others we expect. So overall, I think on the other side, on the deposit side, with sort of the CASA supporting us, and on the asset side with the jewel loan portfolio somewhat insulating us from rate movements, I think we can get to a 3.8% to 3.9% kind of NIM. And that's our expectation for the current year.
Okay, and on the ROA number, and I'll break this up into two. One is FY26 and then in FY27. So FY26, what should the expectation be like? And thereafter in FY27, as you mentioned that there'll be a bit of a kicker thereafter, what should the ROA expectation be?
ROA is at 1.88. I think fairly good. I'm sure you will acknowledge that it is good. See, there's this, like I said, significant amount of initiatives have been taken, and part of that is on the IT side. IT is something that we see a significant ramp of capex happening. Like I mentioned earlier, we are putting in the LOS, LMS. We are completely revamping the internet banking, and a whole host of IT initiatives have been taken to modernize the bank. So that is one aspect that is going to take a bit of cannibalize the profit a bit. The other aspect that we are also looking at is how do we reorient our branches towards strengthening the liability franchise. So a bit of an investment is going to happen on the branches side also. We are looking at something like 50 branches to be initiated in the current year, to be opened in the current year. I think that we'll try and see whether we can sort of speed up in the first quarter, first half year itself. I think we'll be looking at how most of this can be opened in the first half year. So some bit of an uptick will happen on the capex side in terms of where we see expenditures happening. But I am confident that we can still control the cost to income ratio to well under 50. So that's where we will be. And the expenditure we are and our own initiatives internally discussed and initiated would see these additional expenditures coming from additional profits. So 10 to 12% of profit is something that we have given ourselves, and we.
Okay, 10 to 12% PAT growth. Anyway, point taken, sir. Thank you so much, sir, for joining us this afternoon, giving us all of those insights. Wishing you all the very best for a very successful FY26. But out of time on this edition of KYC. I hope this was helpful. And stay tuned to NDTV Profit. More action on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buyback is a Naukri Info Edge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
In the last 1 month, if you see, the share prices of Lloyds Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Markets tumble as tensions escalate between India and Pakistan. Fears of war resonate in the Nifty and Sensex, which are down over 1% each. Defense stocks are the worst hit. The Indian Army hits back at Pakistan. Provocation along the line of control. Homes of Lashkar terrorists destroyed by India as the Pakistani army opens fire at multiple places along the LOC. A meeting is scheduled to be held at 4 p.m. today at the Home Minister's residence to finalize how to withhold Indus River water to Pakistan. Margins of FMCG companies remain under pressure as urban demand remains slow. Nestle India and HUL lose over 1% each. Oil and gas heavyweight Reliance Industries is expected to post flat operating profit thanks to a slowdown in its oils to chemicals and retail businesses. Auto major Maruti's margins and profits are expected to fall. China is mulling reducing tariffs on some goods from the US to control prices, according to Bloomberg. China is also considering reducing 125% tariffs imposed on the US. Hello and welcome to Markets at 12. This is Malika Mishra. Now, before we talk about markets, yes, they're jittery too. Let's turn our attention for a bit to the pressing developments unfolding on the national front. The terror attack in Pahalgam, which left 26 civilians dead, has ignited a firestorm between India and Pakistan, pushing our already strained relationship to the edge. Attributed to Pakistan-based Lashkar-e-Taiba terrorists, this tragedy has triggered a cascade of diplomatic salvos, border clashes, and an anxious spotlight on Jammu and Kashmir. So what's happening now there, and where is this heading? We have NDTV's Shiv Arur reporting from Ground Zero.
Here at the nerve center of Srinagar, Lal Chowk, there is
a palpable mood of anticipation over what's going to come next. And this is happening across two tracks. One, the larger zoomed out context. What kind of action is the Indian government planning to take? Because any action it takes will have a bearing on Jammu and Kashmir. There is no doubt about that. The other track that is obsessing minds everywhere here, and not everyone is really willing to talk, is about the economy of Jammu and Kashmir. In the aftermath of the Pahalgam massacre, people are wondering what livelihood is going to look like. After the Article 370 abrogation and the huge pickup in tourism and economic indicators here in Jammu and Kashmir, things were on an uptick. There was a buoyancy about life in Jammu and Kashmir. There was a cultural resurgence, and people seemed to be on a comeback trail, if they could even call it that. Here in Lal Chowk, which has always been a barometer of Srinagar and Jammu and Kashmir's mood, that was definitely the case. But now, as the vacationers have fled and as uncertainty fills the air, it remains to be seen which path ahead is actually chosen.
Right, and with that, moving on to how the markets are performing at the moment. Benchmark indices, as I've already mentioned, have shed a substantial amount of weight since morning, with the Nifty slipping below 24,000. As you can see, it's trading around 23,800 at the moment, and the Sensex has dropped by over 1,000 points as well, trading around 78,600 levels. The broader markets excruciating too, with the mid cap 150 and the small cap 250 both axed by over 3%, now around 3.5% down. In fact, the small cap 250 index. The top contributors to the pain in the Nifty 50 basket at the moment are a couple of banking names like Axis Bank, HDFC Bank, ICICI Bank, Bharti, Airtel and L&T are contributing to the pressure as well. Axis Bank, in fact, bet its estimates on lower credit costs. If you look at the Nifty 50 heat map, apart from a handful of IT counters, you'd notice that Tech Mahindra, Infosys, like Tech Mahindra, Infosys, TCS, HCL Tech and SBI Life are the only ones in the green. Apart from that, the entire Nifty 50 basket is currently in the red and is shedding a lot of weight. In fact, if you'd see a similar reflection of this in the sectoral heat map as well, where you'd see only the IT index performing, with a lot of others majorly in the red. Media, defense, realty, energy, metal, pharma, PSU Bank are currently the top losers. Let's take a look at the advanced decline ratio as well to get a sense of how the market is currently breathing. And you would see that just about 121 as compared to 2,099 stocks. That's almost the entire market is currently more favored towards the declines, sort of representing a pressured market breadth at the moment. But moving on, viewers, a host of consumption stocks reported their Q4 earnings yesterday, namely Tata Consumer, HUL and Nestle. Overall, a steady show across the list. However, margins remain under pressure. My colleague Mahima, who closely tracks the space, is here with the details.
In terms of overall view for all of these three Nifty 50 earnings, Tata Consumer numbers were pretty much largely in line, HUL numbers largely in line, and Nestle was a slight beat in terms of what the numbers came out to be versus its estimates. Now, in terms of where revenue and PAT growth is concerned, Tata Consumer saw a double-digit growth of 17% in revenue. PAT growth was 59%, but there was a one-off item of exceptional gain of around 120 odd crores. For HUL, this growth was 2.4% in terms of revenue and 3.6% for its PAT. Nestle saw 4.5% growth and a negative PAT of 6.6% growth, but that was still better than what the street was expecting. Street was expecting a negative 8% growth in PAT. So overall, in terms of revenue and PAT growth, Tata Consumer fared out to be better than what HUL and Nestle came out with. In terms of volume growth, well, Tata Consumer saw volume growth of 6%. This is the first time that Tata Consumer did come out with its number with respect to what its underlying volume growth was. HUL and Nestle both saw volume growth of around 2%. So here also Tata Consumer was better placed than Nestle and HUL. In terms of common trends being observed, margins definitely still under pressure. Higher tea costs have highly affected margins of HUL as well as Tata Consumer. Gross margins will remain under pressure in first half of FY26 is the commentary that management has commonly said. And in terms of growth, revenue growth was led by pricing for all of these three companies. E-commerce growth has strengthened and faster growth has been seen in lower end products as compared to premium products. So that's a new trend that is coming out in FMCG. In terms of demand, rural recovery is taking place, but it is gradual. Urban still under pressure. In terms of the last metrics, dividend has been declared by all of these three counters. Tata Consumer 8.25 per share, HUL at 24 rupees per share and Nestle at 10 rupees per share. So this is the overall view as to how so far FMCG earnings have fared out to be.
Right, Mahima. Thank you for giving us a perspective into those very important three major FMCG earnings. Now, we spoke to Abneesh Roy from Nuvama Institutional Equities about how the overall consumption story is currently poised, especially in the backdrop of these earnings. Listen into a slice of that conversation.
People are fairly down and out about this entire basket. We were speaking with Deepan a short while ago saying that those who have generationally inherited these stocks should cash out. How are you looking at the numbers?
Sure, thanks. Good morning. So we don't think things are as bad as some people are saying. One is, of course, from an outlook perspective, things will improve in FY26. Second successive good monsoon. Food inflation has also cooled down and we expect more correction there. Interest rate also 2 cuts have happened. Salary also April will be the first salary where the tax rebates will kick in. So FY26 definitely looking better. From a investor interest perspective, also defensives are coming back in favor gradually because of the overall global uncertainty and global slowdown. Now, coming to this quarter results, as your reporter also highlighted, numbers are in line with expectation and urban slowdown will continue at least for one more quarter. So even in Q1, we don't see a dramatic recovery for the staples companies. Currently, our topics in the broader consumption space will be essentially the liquor stocks, United Breweries, United Spirits. We also like Pidilite and Marico. So these will be our topics. FMCG staples, as you rightly said, currently because of the urban slowdown and because of the raw materials inflation, which is currently still there. Palm oil is still 20-25% up. It has corrected from the peak. Tea is up again 25% and a lot of the copra, etc. are still up. So Q4 and Q1 margin pressure, urban slowdown will still continue. From Q2 is where the recovery should start for staples. Till then, we'll be more positive on the liquor companies, Pidilite and Marico.
So Q2, there are other people that are talking about H2 FY26. So point well made, Abneesh. Hi, Alex here. One of the points that Mahima was talking about after looking at the numbers that she reviewed yesterday is that down trading is evident for these companies. Is that a trend that is likely to continue, and what are the implications therefore for the margin picture? And I know that you're saying that staples will improve second quarter onwards, but then are we likely to see subdued margins? I think that's why HUL took a hit as well.
So yes, HUL yesterday post results, in fact, stock was up. But when the outlook statement on margins was seen, then investors did get worried. And that's why there is a cut in terms of the EPS for FY26 by most of the street. Because company earlier outlook was 23 to 24% EBITDA margin and now 22 to 23. Now, where is this 100 bips going by Unilever? I think they are clearly investing in 2-3 spaces. One is they want to make 3 more challenging brands, Lifebuoy, Glow and Lovely and Horlicks. They want these growth to come back. Second is they have noticed the improving macro food inflation and second successive good monsoon. They want to invest now because you have to do it before the macro really turns. If you delay that, then other competition will catch up. We also see the global CEO of Unilever driving some of this because he is very positive on India and he is more aggressive than the earlier CEO. So we see that also possibly could be one of the reasons. Coming to other companies, as I said, Tata Consumer, next tea crop is very important. We'll get clarity in the next 3 months. So Q1 margins will remain under pressure. For Nestle, if you see, wheat crop is looking better. So Nestle and Britannia, my sense is wheat crop is very important, and that is looking better than last time and better than initial expectation. So I will say every company you have to take one by one, but Q2 is where I think clearly we'll see the demand situation start improving because that comes into the base, and as I said, some of the tax rebates will kick in, food inflation. But from a competitive intensity, I think clearly the legacy companies will acquire a lot of the D2C companies. So we'll see that trend continue.
So overall, the second half of the year might turn out to be better for FMCG in the consumption space. Moving on, viewers, Reliance Industries may most likely report a flat operating profit sequentially in the March quarter due to weak earnings in its dominant oils to chemicals business. It is also expected to display a muted growth in its retail business. Let's bring in my colleague Somit to give us a better idea of what the street is expecting out of these results.
Well, yes, Reliance Industries' fourth quarter on a consolidated basis is expected to be quite muted, though revenues of the company would be higher by around 26% as per the estimates. But EBITDA is expected to be down by nearly 1%, and this will result into very sharp drop in the EBITDA margins. It could come in at close to 14.3% as against 18.2% reported by the company in the previous quarter. Net profit is expected to be flat at close to 18,500 crore rupees. Now, segment-wise performance, if you look at, it's the O2C business which will be the main drag on the financials, and that will be largely on the back of lower gross refining margins and weak petrochemical margins. O2C segments EBITDA is expected to be 3% lower on a sequential basis. EBITDA of retail is expected to drop by nearly 9%, but that is largely on account of the fact that Q3 is a seasonally strong quarter because of the festive season, and hence we are seeing this drop. When it comes to the oil and gas exploration business, that is expected to be around 5% on a sequential basis, and this is largely on account of lower gas volumes in the fourth quarter as against the third quarter of FY25. The only segment that is expected to report a growth is the telecom business. Now, if you look at Reliance Jio, which is the telecom arm, revenue, EBITDA and net profit is expected to be higher by anywhere between 1.5 to 2%. The ARPU is expected to be 1% higher. Subscriber number is expected to come in at 48.76 crore, and entire growth for the telecom business will be led by ARPU and on the back of the tariff hike and because of the subscriber addition that the company has done. However, do remember that the ARPU growth is slowing down, and this is the slowest growth that will be seen in the last 3 quarters. Now, a company had taken a tariff hike 3 quarters back, and that's the reason we are seeing this kind of a growth on the ARPU and the tariff front. Now, the key things to watch out from the Reliance Industries earnings would be margin outlook in refinery and petrochemical business, their outlook for the new energy business, what is the commentary that comes in on ARPU post tariff hike, Geo Fibers growth, and any commentary on capital expenditure outlay and how they plan to reduce their debt now going forward would be important to track from Reliance Industries earnings.
Right, Somit, thanks for that. And speaking of more expectations from other counters, Maruti Suzuki India is set to announce its Q4 results today as well. What can we expect from the auto giant? Well, I have my colleague Puneet joining us for more. Puneet, how does the expected picture look like?
Well, thank you for that. So Maruti definitely is one of the biggest earnings and the first one in the auto pack to come out with earnings today. Largely, revenue is expected to rise by roughly 12% to come out at 40,900 crores in this particular quarter, and margins are expected to rise by 5%, but the overall margin is expected to fall in this particular quarter, and that's largely because of commodity prices as well as larger investments that the company has done over the last 90 days. In this particular quarter as well, we saw some discounting as well in March, which is generally a month where discounting is very limited. So might see some impact of all these factors, and we're expecting the overall margins to fall by 80 basis points to come in at 12% versus 12.8% the same time last year. Now, in profit as well is expected to be largely flat to a negative bias, coming at 3,856 crores. And if you look at the quarter gone by, the company's main highlights was that while there was some volume growth seen in this particular quarter, we are seeing that higher realizations should support revenue growth, but because of these incentives that the company gave in terms of sales, that's affecting the margins as well as net profit. Depreciation also might be on the rise in this particular quarter because of new plants and costs which have been coming, so watch out for that as well. In terms of sales, the company sold 6.04 lakh units in this particular quarter compared to 4.84 lakh units. The share of SUVs has gone up, but the smaller car share has fallen. So, and that's the reason why there's a discounting impact coming in as well. Finally, in terms of price hikes as well, the company's actually announced 3 price hikes between January as well as April. The January price hike of 4% as well as the February price hike, between 1,500 to 32,000 rupees per model has been something which is not something that the company usually does. So it's a January price hike is quite common, but the two other price hikes has shown that the commodity cost has been impacting as well. We will be looking out for some commentary into demand for FY26. So overall, while we're expecting growth in terms of revenue, I think margins will be something to watch out for in this particular quarter for Maruti Suzuki.
That definitely sets the picture right for us. Now, Tech Mahindra also came up with its Q4 results yesterday, posting numbers that were largely in line with estimates. Now, brokerages have a mixed view of Tech Mahindra. Kotak and Investec have maintained a buy rating, whereas Citi and Macquarie remain a bit bearish on the counter. Puneet, what do you gather from all of this on Tech Mahindra?
Well, Tech Mahindra, very interesting results to say the least, because while the numbers were largely in line with estimates, we actually saw the stock tank in trade at the start of roughly about 4%, and we'd given it a thumbs up. We've seen a recovery in the stock price as well, and that's largely on, a multitude of factors in the results as well as positive brokerage notes that have come in now. So when you look at, the top three segments for the company largely reported a flat to low single-digit growth of banking as well as, TMT. So hence, it was a good quarter for the company. We've seen revenue largely being flat at 0.7% growth, while, the margins have come in at 10.5%. compared to 10.2% the same time last year, with estimates being around the similar range as well. Net profit was also up 18% in this particular quarter, largely baked into estimates because of a higher other income portion, coming in at 1,167 crores. Now, company had deal wins of $798 million in this particular quarter, taking the total of $2.7 billion for the year of FY25. And very interestingly, it's higher than analyst estimates as well of 750 million. Finally, when you look at brokerages, as you rightly mentioned, we've seen something like Kotak being very positive. Target price was 1,650 rupees per share for Kotak. And there are three key points that the brokerage is making. First one, deal wins provide a much needed portfolio boost to margins over the next 8 quarters of the company's vision of FY27. They've also mentioned that the company, they believe that Tech Mahindra is on its way to maintain and achieve the 15% EBIT margin target for FY27. Currently, they are between 10 to 11%. So it's a steep jump expected in the next 8 quarters. But Kotak is very positive on the brokerage as well as the company as a whole. Investec as well. Target price 1,672 versus 1,510 earlier. And they've also maintained a positive view, saying that the deal wins have grown 42% in this year compared to FY24, and is the highest amongst peers. While they've also mentioned ROCE has improved to 22 from 14%, they believe that Tech Mahindra is the only tier 1 company who could potentially deliver the highest growth in this decade compared to the previous one. And just a couple of lines on the two brokerages such as Citi as well as Macquarie, largely maintaining that the EBIT margin could be something that's a very steep target for the company, and they feel that there could be some EPS cuts going forward. But overall, it's a positive result for the company, and a few brokerages maintaining the stance that they could achieve the target of 15% EBIT margins in FY27.
Right, Puneet. Thank you so much for those updates. And staying on quarterly earnings, viewers, Axis Bank also reported its Q4 earnings and their profit bet estimates, but loan growth disappointed. Let's go across to Harsh for more on the results.
When you're looking at the overall set, it looks like a decent set that's coming from Axis. Margin expansion of 4 basis points, that's a bit of a surprise. Didn't expect that coming from Axis. The NII number was a slight miss, but that's largely driven because loan growth came in lower and not because margins were compromised. So margins actually have gotten better, which is the positive surprise. But where your NII number is concerned, it's a slightly softer number, but that's largely led by loan growth. Loan growth was extremely soft. Something to keep in mind, again, just 8% up YOY, the loan growth. And missing estimates, maybe by around 1.5% at the very least. So maybe that's something to keep in mind. The other piece is with regard to OPEX. OPEX was elevated, operating profit largely in line. You saw provisions number largely lower, in fact sharply lower when you're looking at it sequentially as well. Credit costs were down around 30 basis points, came in at just 0.5%, and profit after tax therefore got a lift. Your ROA hit 1.8%, your ROE hit 17%. Both of those metrics extremely strong, given the fact that that's the aspirational ROA, ROE of Axis, and they haven't been able to do that, and therefore clearly a positive. But disappointing in a big fashion with regard to growth. Just 8% on loans, just 10% on deposits. Not looking good from that perspective. 7% QOQ deposit growth looking very impressive. So on the QOQ number, it's very solid. But on the YOY number, loans, overall disappointment, deposits also disappointing.
Right, Harsh. Thanks for that update on Axis Bank. And there are some other companies that have been buzzing today in the stock market as well. Aavas Financials, IEX and Tanla Platform, in fact, came up with their quarterly results. And my colleague Varsha, in fact, is standing by to explain how the results of these three companies have been so far.
Yeah, thank you for that. Let me start with Aavas Financials, wherein NII growth was up 10% quarter on quarter. Best margins for FY25 clocked in. A protected ROA in FY25 versus 24. Despite margin decline, asset quality was solid. What didn't work for the company? Well, the growth, there was a dip in the growth and at 18%, slowest in 8 financial years. Next on my list is Indian Energy Exchange, wherein net profit did meet estimates, achieved highest ever quarterly traded electricity volume of 31.7, which is up 18% year on year. 68 lakh RECs were traded during the quarter, which more than doubled. Highest ever RECs traded in quarter. Last on my list is Tanla Platforms, wherein revenue growth that you are seeing, that is up to 2.4%, was led by OTT, and the OTT contribution to the overall revenue, if you see, was at 29%.
Thank you so much for that. And Kashmir, a region known for its breathtaking landscapes and cultural charm, has long been a symbol of resilience and beauty, as 2025 ushered in record-breaking tourism numbers. Optimism for the valley's recovery blossomed after years of challenges. However, the devastating terror attack has shaken the foundation of Kashmir's tourism sector. Let's take a look at this report that delves into the profound impact on the region's economy and the livelihoods that depend on it, and the immediate repercussions on bookings, cancellations, and traveler sentiment.
An endless lineup of empty houseboats, no customers, no tourists, because they've all completely left Srinagar. They've left Kashmir, and who can really blame them?
This is Dal Lake, Kashmir's crown jewel, vibrant and bustling just days ago. Now, a haunting stillness blankets these same waters in the aftermath of the brutal terror attack that claimed 26 innocent lives. 2025 began with tremendous promise for the valley. Nearly 8 lakh visitors flocked to Srinagar's iconic Tulip Garden in just 26 days following its late March opening. But this resurgence, a hard-won victory after years of struggle, now faces a devastating setback. The gruesome terror attack has struck at the heart of the state's tourism sector, which had only recently celebrated a historic milestone with 2.35 crore visitors in 2024.
टूरिज्म सबसे पहले हिट होता है और कैंसिलेशन आ रही हैं जो कल तक 15 से 20% थी, आज 40% के करीब से ऊपर चली गई हैं और नई बुकिंग कोई अभी आ नहीं रही है.
Tourism isn't merely an industry here. It's the economic lifeblood of Jammu and Kashmir. Pahalgam, the site of this tragedy, stands as one of the region's premier destinations and serves as a crucial gateway for the sacred Amarnath Yatra pilgrimage scheduled for July.
चीज़ें रिवाइवल इसका हो जाएगा जल्दी एंड आई एक्सपेक्ट कि अगले 15-20 दिनों में थिंग्स शुड स्टेबलाइज.
The immediate economic impact has been swift and severe. Clear trip reports a 40% plunge in future Kashmir bookings. Flight cancellations have multiplied 7-fold. Cancellation requests surged by 25% in the first 24 hours after the attack. Safer Himalayan retreats in Himachal Pradesh and Uttarakhand are seeing increased interest as travelers redirect their plans. The attack on Pahalgam represents more than a tragedy for the victims and their families. It's an assault on Kashmir's economic recovery and the livelihoods of thousands who depend on tourism. While government officials and industry leaders express cautious optimism about resilience, the valley now faces a critical test. Can the hard-won peace and prosperity of recent years withstand this latest challenge? As summer approaches, traditionally Kashmir's peak tourist season, the answer will determine not just vacation plans, but the economic future of a region fighting to move beyond its troubled past.
With that, that's all the time we have on the show, but do stay tuned to NDTV Profit for more news and updates.
That's huge. That is a biggie. It's out of it.
Gold Plus Clear Glass. Far ho ya near, सब कुछ दिखे clear.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
In the last 1 month, if you see, the share prices of Lloyds Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to NDTV Profit. You're watching Profit Buzzers. A very good afternoon to all the viewers. I'm Hiral Datia and with me is Mika Barve. Firstly, a very happy birthday to Mika.
Thank you so much.
It falls on a Friday, so it is going to be a party weekend for all, at least with regards to where Mika's birthday goes. But what's happening in the Indian markets and what's happening in the country, the Indo-Pak tensions, is something which is impacting the domestic markets as well. So far, the sentiment and the morale is something which has been impacted so far, and that's why you're seeing this kind of a sell-off in the stock markets as well. If you see in terms of Nifty 50, a very mild recovery from the day's lows, but the pressure continues. We're seeing cuts of almost around 1.3% in trade that is coming in. Let's quickly pull up Bank Nifty, and after that, I beg your pardon, if we can have the sectoral heat map as well to understand what's happening with regards to the sectors as well. There you go, 1.4% is the kind of cuts that you're seeing in terms of Bank Nifty as well. You just have Nifty IT, which is trading in the positive, but apart from that, it is a sea of red. IT as well, seeing marginal gains of around 0.6%. What's losing? Media, the top loser today, followed by defense. It's very interesting to see how defense as a space during these times of tensions is drooling under pressure, because usually the trends that we've seen is any war-like situation that comes up across countries, across the world, it's the defense pack which is always on an upstill. But this is the time where it has been trading under pressure. Let's quickly look at the Nifty 50 heat map to understand the trend in terms of individual stocks, what's happening in the large cap space. There you go. It's just SBI Life is an interesting one on the back of earnings, the top gainer in today's day of trade. Apart from that, Infosys, TCS, these are two other stocks which are also seeing some smart moves. Axis Bank on the back of earnings is trading under pressure, the top loser in trade today. Mika, so that's with regards to where, you know, the benchmarks go. The pressure has continued. Broader markets, last couple of trading sessions, we are seeing a stock-specific action.
Yeah.
I mean, but clearly you are seeing the pressure there as well.
Yeah, and the picture is very much leaning to the bear side on the broader markets as well for this Nifty small cap as well as the mid cap indices. We've seen some recovery. Intraday lows were over 3%. Right now, the indices are trading cuts of 2.3 to 2.6%. But if you just pull up the Nifty small cap 250, which is down 2.7% right now, 229 stocks on the counter are currently trading in the red, while only 14 are advancing. Something that's seen as the top loser in the Nifty small cap 250 is Jai Balaji. The stock is down almost 8%. This is followed by Motilal Oswal seeing cuts of almost 7% right now. And then you have a defense player, Garden Reach, down about 6.5%. You also have some weakness in counters like Keynes Technologies, Blue Star, MMTC, all seeing cuts of over 5%. On the positive side, something that you are seeing positive movement is a Sterlite Technology. It's up 5%. But this is after the stock fell almost 25% yesterday after a spin-off of one of its arms. Navin Fluorine up 2.5%, Novama, IEX on the back of results. But even the strength in these counters has weakened. IEX was up 4% at the start of trade. Now it's trading just 1.5% above here.
I mean, a lot of stock-specific action, but it's mainly the Indo-Pak escalation. And the fears around it is what is gripping the Wall Street, and that's what is keeping the markets under pressure. A lot of selling that's coming in as well. People are not really looking at building long positions as well, taking into consideration it's the weekend and what could transpire out of the geopolitical crisis right now. But let's address the big story this afternoon, the Pahalgam terror attack, which has left 26 civilians dead, has actually ignited a firestorm between India and Pakistan, pushing their already strained relationship to the edge. Indian Army has retaliated to the firing initiated by the Pakistan Army on the line of control. In fact, firing from multiple Pakistani posts across the LOC was reported.
Two houses of two Lashkar-e-Taiba terrorists linked to the attack were destroyed overnight, attributed to the Pakistani-based Lashkar-e-Taiba terrorists. This tragedy has triggered a cascade of diplomatic salvos, border clashes, and an anxious spotlight on Jammu and Kashmir. Eyewitnesses said that the heavily armed terrorists emerged from the pine forest and opened fire at unarmed tourists.
In fact, the Indian Army Chief General Upendra Dwivedi has reached Srinagar also to take stock of the security situation in Pahalgam. He will hold a meeting with top commanders in Srinagar and is also likely to visit the Baisaran Valley. So what's happening now there and where is this heading? We have NDTV's Shivaru reporting from Ground Zero. Over to you.
Here at the nerve center of Srinagar, Lal Chowk, there is a palpable mood of anticipation over what's going to come next. And this is happening across two tracks. One, the larger zoomed out context. What kind of action is the Indian government planning to take? Because any action it takes will have a bearing on Jammu and Kashmir. There is no doubt about that. The other track that is obsessing minds everywhere here, and not everyone is really willing to talk, is about the economy of Jammu and Kashmir. In the aftermath of the Pahalgam massacre, people are wondering what livelihood is going to look like. After the Article 370 abrogation and the huge pickup in tourism and economic indicators here in Jammu and Kashmir, things were on an uptick. There was a buoyancy about life in Jammu and Kashmir. There was a cultural resurgence, and people seemed to be on a comeback trail, if they could even call it that. Here in Lal Chowk, which has always been a barometer of Srinagar and Jammu and Kashmir's mood, that was definitely the case. But now, as the vacationers have fled and as uncertainty fills the air, it remains to be seen which path ahead is actually chosen.
Thank you, Shiv, so much for getting us all the ground report as well. And that is what NDTV will be continuing throughout the day as well. But let's also welcome in our guest, Pramitpal Chaudhary at Head South Asia Eurasia Group. Pramit, you have been covering the geopolitical scenario specifically with regards to India, Pakistan as well since quite some time. What is this actually telling you with what's happened and the kind of steps that the Indian government has taken so far? Because when we're relating that to what's happening in the Indian markets, it seems there is fear that is gripping investors as well.
Well, I think investors are right to look. They probably look back at what happened when we did the Balakot strike in 2019 after the Pulwama attack, and you saw there was almost 2 weeks of buildup in India, wars carried out diplomatic action, some economic activity, but more important, primed the international system as to what was going to happen, that there would be some sort of a reaction, but explained India's case. And then, of course, put together the military option that was eventually carried out with the airstrikes against the attack in Balakot. So there's an assumption that a very similar path is now being practiced. You see in India announce the obvious easier diplomatic and economic actions, including suspending the Indus River Treaty. We're also seeing, of course, diplomatic action where Modi has been talking to world leaders and ambassadors from various G20 countries are being briefed. So you see that similar kind of path. And Modi, and notice Prime Minister Modi, when he was speaking in Bihar, switches to English and says that he promises significant and stringent action against the terrorists in a manner that they would not expect. So it seems a very similar glide path, a steady escalation towards some sort of violent retaliation, military or otherwise, by India, and possibly within, again, over the next 2 weeks. Although I'd say the window probably may be opening by the end of next week. So understandably, this is a degree of uncertainty. Can you control the escalation, I think, is one. It's less about the idea of a military retaliation Then the question of escalation, I think that's a crucial element in this. Last time, as you remember, Pakistan responded to the symbolic bomb attack in India on some empty ground. There was a dogfight between a couple of fighter aircraft, and then it was basically over. We assume a similar kind of game right now, but until it actually happens, these are, after all, two nuclearized nations. It will be difficult for anybody in the market to assume that this is going to happen.
Pramit, Mihika joining this side, the tensions remain high. You've seen certain economic as well as diplomatic steps taken by India and retaliation from Pakistan. But what would be the logical next steps from an Indian perspective?
I think the next step would be diplomatic preparation. I mean, the real accomplishment, I would argue, in the Balakot strike was not whether or not they actually hit targets on the ground. Normally, after a terrorist attack, terrorists vacate their camps because they expect a retaliation. And in any case, an organization like Lashkar-e-Taiba, no matter how many hundreds you kill, can recruit a similar number virtually overnight. Pakistan has over a 45% unemployment among young men. What really was interesting was Pakistan's complete diplomatic isolation. The four countries that I would argue have traditionally been their supporters, Saudi Arabia, the United Arab Emirates, the United States, and China, historically the ones that have been most friendly with Pakistan. Three of them basically said, we support India. India has perfect right to retaliate for a terrorist strike. And China, the fourth one, and the strongest and really the only remaining ally of Pakistan today, basically said, we're neutral. The two of you work it out yourself, but we have no position to take on this. So for Pakistan, I think it was a bit of a shock. I met Pakistani diplomats who said we were surprised because there was simply no support for us anywhere in the world. And remember, unusually in that attack, India did not hit POK, Pakistan occupied Kashmir, because we always had this little loophole where we would say, we're not striking Pakistani territory, we're attacking occupied Indian territory, which therefore is not a violation of international law. In Balakot, we struck Khyber Pakhtunkhwa. The Balakot is not in Kashmir, it is in Khyber Pakhtunkhwa, in territory that is undeniably Pakistani as far as India is concerned, and we don't make any claims to it. So in effect, you hit Pakistani territory. Pakistan rightly went and complained to everybody, hello, this is an act of war. And everybody says, we don't care. So for us, making sure that a similar situation happens, I think is crucial at this point. And then weighing what are the options. I would argue we not only have a military air option, to this day, and we are much better armed than we were in 2019. The Rafales are now in play, which they were not in 2019. They actually just began arriving from their factories at that point. We have much better standoff missile capacity, means long over the horizon ability to hit targets, much better targeting technology. But we also have developed, to some degree, it seems, some covert capacities. If you've looked over the past 3 or 4 years, India there have been at least roughly 20 assassinations of Pakistani terrorists, especially those associated with the IC-814 hijack in Pakistan by unknown groups, which the Pakistani military has accused India of accomplishing. And that seems very likely, which indicates that we have developed something which we did not have before, which is covert action capacity inside Pakistan, which potentially could also be brought to bear on this.
Right. So, Pramit, do you think something like this could lead to a full-fledged war? And if so, what would it mean for India? Because, you're talking about the Indus Water Treaty. That is something where the meeting will be held today at 4 p.m. as well. And if that is taken into consideration, I mean, how do you expect Pakistan to then, come out with it? I mean, it's a very chicken and egg situation right now.
See, the Indus Water thing, I think, is more symbolic right now. There's a little bit, India does not India may control the headwaters of a number of these rivers. In fact, most of them originate inside Indian territory, some as go far as Ladakh. The problem is that the terrain of Kashmir has been so difficult to work with that building dams, the necessary dams, tunnels for the water diversion and so on, is more or less has proved to be almost impossible. We have some sluice gates in some of the tributaries of some of the rivers, and we could potentially cut that off a little. But what would happen, that would have the potential for disrupting hydroelectric capacity in some of Pakistan's generators, but not enough to affect agriculture. And in fact, I think they've already harvested their wheat, so there isn't much capacity. In other words, if you were to dam those rivers, you would flood India. You would not flood, you may deny river water to Pakistan, but you would flood India because there's no reservoir capacity there on our side, and it's very difficult to develop here. So that's a symbolic action, but it does open the door for us to do things later in the future. But I think that's more about rattling the cage and reminding Pakistan that they are wildly dependent, in fact, wholly dependent on water, both for power and agriculture, and for their cities from water that comes from India. But I think the real issue will be, and economically we don't do much, we do virtually nothing with each other anyway. So that's why I think eventually some sort of kinetic action would have to be considered. Diplomatic isolation, of course, is already there, and I think that will continue. I think the timing of the attack was remarkably bad from Pakistan's point. Not only was U.S. Vice President J.D. Vance in town, and his officials were very strong in their condemnation of the attack while they were on Indian soil. I was in the room with some of them when it happened. Second, there was very strong. Modi was meeting MBS, the king of Saudi Arabia, the crown prince of Saudi Arabia, at the time the attack happened, and had to cut short his trip. I don't see the Saudis being particularly pleased about that. And then finally, it's a time when China is trying to do a rapprochement with India for its own reasons. Again, something not pushed by.
Pramit, I will interrupt over here. So clearly, the timing, as you're saying, is incorrect. The Indus Valley Treaty does give us some power in terms of retaliatory measures. And if you have to look at the Pakistan Army Chief's speech, categorically he's saying that our stance is absolutely clear, where Kashmir was our jugular vein. It will continue to remain our jugular vein, and we will not forget it. And you will not leave our Kashmir brothers in their heroic struggle. A lot of commentary that's coming from there as well. And the clear picture is the speech a trigger for the terrorists as well? Because if that is going to be the situation, and if we are also going to retaliate to protect, where does this lead, number one? And two, the kind of financial losses that you're seeing, not only from a Kashmir Valley perspective, but overall from investments as well in the Indian markets. During Balakot, Pulwama, yes, you did see markets go down and recover in the span of 2 days. Do you think that's going to be the scenario here? Or because right now equity markets are seeing a sell-off?
Well, equity markets will tend to respond to almost any degree of uncertainty, but the sell-off is not strikingly very high. And there are other elements globally of uncertainty right now. So I'm not overly surprised or concerned about that. The likelihood of a full-scale war is very, very minimal because, one, we're nuclear, both of us. And second, it's only India that could precipitate that attack. India's defense budget, even though India has actually reduced defense spending over the past 10 years as a percentage of GDP, in absolute terms, it continues to rise and is now something on the lines of 10 times that of Pakistan's. Pakistan's economy, as you will know, it's just undergone the worst financial crisis in its history. It has virtually no foreign exchange, about $6 or $7 billion, and it has had to actually sell ammunition to, let's say, Ukraine to raise funds for its own military. It has no capacity to wage a war right now. So therefore, I don't expect that to be the path. And India still has, if you wish, other goals, both economic and fiscal, which are in many ways more important in the long run than fighting Pakistan. So I think the real issue, therefore, long-term war doesn't make any sense for either side. So I think the real story, therefore, is what do you do over the next 2 weeks to teach a lesson to Pakistan, inflict a degree of cost on Pakistan that keeps that in mind. I mean, the Balakot attack in 2019 gave us basically almost 5 years of peace with Pakistan on the terrorist front. But you're right, General Munir's statement. General Munir is a very hardline Islamicist. He is a Hafiz al-Quran, which means a man who has memorized the Quran and tends to see the Quran as the answer to almost everything. And there are presumably many benefits in the Quran, but it's not a good document for modern strategic thinking. So he very clearly has that point, and Pakistan has been very unhappy that the abrogation of Article 370, the move to make Kashmir a normal state in the Union has been basically, worked excellently, and after the last elections in Kashmir has been legitimized by the Kashmiri people itself. But they have simply lost almost all influence in what happens in Kashmir. And nobody in the rest of the world cares.
Yeah, got it.
So they need to do something to show we are still a player in that, but it's going to extract a high price from them, I think.
Thank you so much, Pramit, for joining us and giving us a perspective on what's going on and what could happen next. And thank you for joining us.
Thank you.
Yeah. Well, in an update to arguably one of the toughest diplomatic actions taken by India, an important meeting will take place later today at the residence of the Home Minister Amit Shah on the Indus Water Treaty issue. Several union ministers are expected to be present in this meeting. Let's get in NDTV's Aishwarya Jain, who's tracking this closely, to tell us more.
Well, and many senior experts are stating that this will break the backbone of Pakistan, specifically in the regions of Punjab and Sindh of the Pakistan, that there would be the water crisis and the food crisis as well. The CCS decision under the chairmanship of Prime Minister Narendra Modi that Indus Water Treaty should be suspended from the immediate effect had now come down to implementations, and therefore the reason yesterday it was the Water Resource Minister C.R. Patel who conducted a meeting with the MHA and the MEA officials at the ministry and had prepared a blueprint. It is today, later in a day, when it would be Home Minister Amit Shah, External Affairs Minister S. Jaishankar and Water Resource Minister Mr. C.R. Patil, along with the officials of the Jal Shakti Ministry, will be sitting and will be preparing the blueprint and also the technical aspect of it, as to many experts suggested that the provisions of Indus Water Treaty, that's the western rivers that flows towards Pakistan, the water needs to be stopped. And to stop that water, India needs to again function. Those canals that had been constructed, the reservoirs, the dams height should be increased, and all of that needs a time, which is certainly difficult, but it is not impossible as being stated by many senior experts, and this will happen in a definite period of time, is the task behind the government of India, and therefore the reason to come down to the nitty-gritties, the technicalities of it. An important meeting is to be held today evening at Home Minister Amit Shah's residence. All eyes will be on that particular meeting.
Thank you so much for getting us the details. So this is an interesting update, and it's absolute, a diplomatic war that being unleashed so far. But let's quickly slip into a short break. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buyback is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
In the last 1 month, if you see, the share prices of Lloyds Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Markets near day's low. Nifty breaches the 24,000 mark. Sensex down 800 points. Axis Bank and Shriram Finance down almost 4% each, dragging Nifty.
The Indian Army hits back at Pakistani provocation along the line of control. Homes of Lakshar terrorists destroyed by India as the Pakistani Army opens fire at multiple places along the LOC. A meeting is scheduled to be held at 4 p.m. today at the Home Minister's residence to finalize how to withhold Indus River water to Pakistan.
And Laurus Labs stumbles more than 4% in trade despite posting a stellar fourth quarter. The net profit triples, beats estimates, margins above 20% for the second quarter.
Axis Bank down 5% post Q4 results. The net profit beats estimate, but loan growth comes in below expectations.
And oil and gas heavyweight Reliance Industries is expected to post flat operating profit thanks to a slowdown in its oil and chemicals and retail business. Auto major Maruti's margins and profits expected to fall.
Forex heat on Gensol. ED issues lookout circular against the promoters. Summons Anmol Jaggi in foreign exchange violation case.
Welcome back. You're watching Profit Buzzers on NDTV Profit. Now, Reliance Industries may most likely report a flat operating profit sequentially, and this is with regards to the fourth quarter, mainly on the back of weak set of earnings in its dominant oils to chemicals business. It is also expected to display a muted growth in its retail business. The stock is currently pretty much flat. I mean, it's cooled off from the day's highest levels as well. Let's bring in Somit to give us a better idea on the expectations. Somit, over to you.
Well, yes, Reliance Industries' fourth quarter on a consolidated basis is expected to be quite muted, though revenues of the company would be higher by around 26% as per the estimates. But EBITDA is expected to be down by nearly 1%, and this will result into very sharp drop in the EBITDA margins. It could come in at close to 14.3% as against 18.2% reported by the company in the previous quarter. Net profit is expected to be flat at close to 18,500 crore rupees. Now, segment-wise performance, if you look at, it's the O2C business which will be the main drag on the financials, and that will be largely on the back of lower gross refining margins and weak petrochemical margins. O2C segments EBITDA is expected to be 3% lower on a sequential basis. EBITDA of retail is expected to drop by nearly 9%, but that is largely on account of the fact that Q3 is a seasonally strong quarter because of the festive season, and hence we are seeing this drop. When it comes to the oil and gas exploration business, that is expected to be around 5% on a sequential basis, and this is largely on account of lower gas volumes in the fourth quarter as against the third quarter of FY25. The only segment that is expected to report a growth is the telecom business. Now, if you look at Reliance Jio, which is the telecom arm, revenue, EBITDA and net profit is expected to be higher by anywhere between 1.5 to 2%. The ARPU is expected to be 1% higher. Subscriber number is expected to come in at 48.76 crore, and entire growth for the telecom business will be led by ARPU and on the back of the tariff hike and because of the subscriber addition that the company has done. However, do remember that the ARPU growth is slowing down, and this is the slowest growth that will be seen in the last 3 quarters. Now, a company had taken a tariff hike 3 quarters back, and that's the reason we are seeing this kind of a growth on the ARPU and the tariff front. Now, the key things to watch out from the Reliance Industries earnings would be margin outlook in refinery and petrochemical business, their outlook for the new energy business, what is the commentary that comes in on ARPU post tariff hike, Geo Fibers growth, and any commentary on capital expenditure outlay and how they plan to reduce their debt now going forward would be important to track from Reliance Industries earnings.
Somit, for getting us the views as well so far. But let me just pull up a long-term chart. If we can just have a 2025 chart in terms of YTD for a Reliance Industries. I mean, today it's absolutely flat, but if I can just have the YTD chart. There you go, a 7% up move, but it's been absolutely volatile. Let me welcome in our guest, Mr. G. Chokalingam, founder and MD at Economics Research, and Akshay Bhagwat from JM Financial. Welcome to the show, gentlemen. Mr. Chokalingam, how are you looking at a Reliance Industries now, taking into consideration the kind of volatility it has seen in terms of 2025? The pressure the oils and chemicals and the retail business is expected to see, as per what Somit was pointing out, how would you watch out for it?
Yeah, definitely. I do agree with your team's presentation on short-term outlook of Reliance. It would be subdued, no doubt. Oil and gas and retail, physical retail stores will pull down the performance. But still, the medium to long-term outlook seems to be good. As you also mentioned about telecom, which is remaining very promising area of growth. And last quarter itself in FMCG, they built a turnover of around 8,000 crore. That is another trigger point. And third trigger point would be the buildup of new energy business. So these are the 3 triggers which will help the stock to do well in medium to long term. But investors have to prepare themselves for, expecting very subdued performance in the short term.
Right. Akshay, what are charts indicating with RIL? I mean, in the last 12 months, a 10 to 11% is the kind of cuts that you're seeing. Is there any opportunity, or would you say this is the best time to avoid?
Good afternoon. Well, if I were to look at the longer term charts, in the monthly charts, clearly there is a strong trend line support, and Reliance hasn't reacted much. It has been on the trend line support. It has spent around 5-6 months trading in a range of 1200 to 1300 as it stands right now. So the trade trigger will be once the levels of 1330 spot or cash levels of Reliance are taken out. Whatever the result may be, if these price levels are breached on the upside, you can expect a 6-month breakout of a range, which can easily see the stock sailing up for levels of 1470. So overall, it's more of a conditional buy call. If you want to take a trade on Reliance, it is above 1330. In case you're holding on to the buy trade, then continue to the hold. Only below 1160 does this trend break, and we have a negative trend in that case. Right now it is neutral, but still in the positive zone as it stands on the monthly charts.
Got it. Well, that's the view coming in from the technical charts of Reliance. But another Nifty 50 company that is set to announce its Q4 results today is a Maruti Suzuki. Now, what can we expect from the auto giant? Let's bring in Puneet for more on this.
Well, thank you for that. So definitely the first big earnings in the auto space, and it's expected to largely be, in the mid-single digit in terms of growth. Revenue is just expected to rise by 12%, but that's largely price-led and not volume-led in this particular quarter. Margins expected to actually fall by 80 basis points on EBITDA, and that's because of higher commodity cost as well as discounting that the company has done in this particular quarter, similar to what's been the industry trend, as well as investments that the company has been ongoing in increasing the manufacturing facilities across India. So those will be hampering margins, and that will be one of the most important numbers to watch out for. It's expected to come at 12% versus 12.8% in the same time last year. This will lead to a net profit being almost flat to a negative bias, reported expected at 3,856 crores. Now, we mentioned that, there is some higher realization because of, price-led growth in this particular quarter, and that will be led by SUVs, specifically while the small car share has fallen. Depreciation is also expected to go up in this particular quarter because of, increasing the manufacturing facility in Haryana. Now, in terms of sales, the company recorded roughly 6.04 lakh units sold in this particular quarter. That's a growth of 3% from the same time last year, while the company has announced 3 price hikes actually between January and April. So we will see effect of that. So I think January price hike of 4%, as well as in February, the company took a price hike of roughly 1,500 rupees to 32,000 for across models. That will help the company's margins in this particular quarter, but largely offset by, as I mentioned, discounting as well. The other key factor to watch out for will be the demand environment from the next year. FY25 was a really flat year for passenger cars, just roughly 3 to 4% growth in terms of sales for FY25. So definitely that, and some commentary essentially on key raw materials going forward like copper will be something to watch out for Maruti Suzuki.
Got it. Thank you, Puneet, for giving us those details. Mr. Chokilingam, I'll come to you. The first auto numbers in the Q4 pack due today. What are your expectations for something like a Maruti Suzuki?
I would avoid Maruti Suzuki. The whole passenger vehicle industry is growing in a poor single digit. In fact, a couple of weeks back, the industry conference, many large players have mentioned that in FY26, the PV sales volume could be in a poor 1 to 4% year-on-year basis, which is not at all encouraging fact. And secondly, when the whole industry is going through tough time, hiking prices a couple of times also is going to work against the demand for PVs in the industry, particularly for Maruti vehicles. And if at all one wants to invest in the large cap, I would prefer banking sector. If somebody is interested only in looking at the automobile, I believe M&M is far superior. It is able to outperform the industry growth in automobiles, and tractor business also doing very well. And its exposure to export is also quite limited. On standalone basis, the predominant portion of the income is from the domestic market. So therefore, I prefer M&M to Maruti.
Right. So that's with regards to where the auto names are concerned. In fact, Akshay, how are you looking at any of the auto majors, or even if you have to look at the auto ancillary pack?
Recently we had a strong bout of recovery in most of the auto names, and specifically if on the basis of price reading on charts, I were to pick names, I think I would go with Tata Motors and Ashok Leyland as the top bets on basis of price chart reading. Now, Tata Motors has been one of the beaten down names till now, and there has been a very strong recovery which I see on the charts. This happens from a very massive support zone of 600. So I believe 600 is a support which is there to stay for long, and it's a good chance if you want to buy from an accumulation perspective, buy and hold with a minimum 2 to 3 month time horizon, where my target projection will be a recovery till 800 to 850. Now, Ashok Leyland is the other name which is a strong momentum name here. It has fallen less, even the auto pack was correcting, and here with the support of 200, this stock is setting up all the way for revisiting its all-time high levels of 260, and further targets open up after that. So momentum based, if you're choosing, it's Ashok Leyland. Bottom fishing, if you are looking for an auto name, it has to be Tata Motors.
Ashok Leyland or Tata Motors looking better when you compare it to something like a Maruti Suzuki. But the next stock we're talking about is GMR Engineering. Another day, 5% lower circuit. If you look at the last 5-day chart of GMR Engineering, it's like a staircase. It's just falling down. And troubles have mounted again after the ED has issued a lookout circular against the company's promoters. Shrimi joins us with more details.
Yeah, so furthering its forex violation probe against Gensol and its promoters, Anmol and Puneet Jaggi, ED learned to have requested, a Bureau of Immigration to issue a lookout circular against both, Anmol and Puneet to prevent, any possible flight risk as investigation deepen into the suspected fund diversion, which ED is investigating at this point. They registered the case yesterday. So Anmol Jaggi, who is reportedly in Dubai, has been summoned for questioning. So ED has actually issued summon on his registered email and address. And in case he doesn't turn up to the summon, the ED can explore even legal options as well, is what source is indicating us. And while his brother Puneet Jaggi was interrogated for over 7 hours at Delhi office of ED yesterday, and in fact, sources tell us that he was grilled on the alleged siphoning off fund of about 300 crores. So yesterday, ED official in fact also conducted searches at premises linked to the company and its promoter across multiple locations. Agencies at this point of time suspect that a portion of term loans, availed by Gensol may have been illegally remitted abroad. Officials also examining at this point that some of the funds were routed through promoter-linked entities, and if cryptocurrency was used as a medium to divert the money is what indication they are getting. So authorities are probing that digital asset like cryptocurrencies were involved in the diversion process or not. And this investigation is still ongoing, and further action is expected as the ED, expanded scrutiny into financial dealing of Jaggi brothers and its associated entities.
Right. Thank you so much, Shrimi, for getting us the details. And this is going to be a developing story as well, which NDTV Profit has been bringing you pretty closely in terms of coverage. But moving on, IEX, that's another stock that is in focus. The profit is up around 18%. However, it has missed street estimates. Now, the stock, in fact, opened the day with good gains. 1.7% is the kind of up move that you're seeing right now as we speak. Varsha standing by us. To Varsha, overall, it's a pretty flattish quarter, but what is it that actually worked for the company that is keeping the stock on the upside?
Yes, so Hiral, the interesting part over here is they've achieved highest ever quarterly traded electricity volume, which is up almost 18% year on year. And when it comes to REC, so 68 lakh RECs were traded during the quarter, which is an increase of almost 100. So more, it doubled actually. And the highest ever RECs were traded in the quarter. Similarly for FY25, if you see, company logged the highest ever traded electricity volume, which is 121 billion units, which is up almost 19% year on year, and 178 lakh RECs were traded during FY25, which saw an increase of almost 136%, and it was the highest ever RECs traded in a financial year. Just to speak on the numbers, revenue were up almost 17%, EBITDA was up 16%, and margins were 86.3% versus 86.5%, whereas the estimates of the EBITDA margins were at around 89%, and the net profit was up 18%.
Right, so that's with regards to where IEX goes. Mr. Chokalingam, how are you looking at IEX taking into consideration the way commodity prices have moved right now?
Yeah, for two reasons, I would maintain a sell call on IEX, especially if the stock is able to move close to around 200. Reason A, the profit growth in the latest quarter is around 18% year on year, but the P ratio is around 38 for FY25. So I would not, pay this kind of P for when the company is able to grow only at around 18%. And the second point is that quite a while ago, it has lost its monopoly status. The competitors have started operation and they are backed by strong, other businesses other than the power exchange businesses. So therefore, I have my own apprehension whether IEX would be able to maintain fabulous growth in the near future. So therefore, I would give a sell call on IEX, especially if it is moving close to 200 rupees.
Got it, Mr. Chokalingam. And Akshay, on the charts, how does an IEX look?
If I were to look at the short-term charts with a time horizon of under a week, we are right now trading at an important resistance zone, which is around 195 to 200. If you recollect the last 6 months, this stock has time and again met resilience, some selling pressure once it nears levels of 180, 190 zone. So right now, it's at the upper end of the band. So I would wait for either the stock to settle about 200 if I were to take a fresh buy position in the stock, or if it corrects from here, the correction may again extend down all the way till 175, which will be the second buying point. So right now it's more of a neutral view, and only about 200 things change, and post that the stock gets back into a strong footing.
So the 200 level, a key one for an IEX. But Aavas Financials is also in focus post its Q4 numbers. The company's margin and asset quality is looking strong. However, the stock is under pressure. Vaishal joining us with the details of the results.
Yeah, so let us just split this into what worked for the company and what did not work. Starting with what is in favor with the company. So if you see, the net interest income growth was up 10% quarter on quarter, and company had a best margins for FY25, which they clocked in Q4 FY25, and the ROAs were protected in FY25 versus 24 despite margin decline. The asset quality remains solid for the company. While what did not work for the company, if you see, the growth has dipped at 18%, slowest in the last 8 financial years. Just on the Q4 highlights, net interest income was up 14% at rupees 271 crore. The impairment was up 25% quarter on quarter, and the net profit was up 7.7%, and the AUM grew almost 18% for the company. On NPAs, if you see, GNPA were at 1.08% versus 1.14% last quarter, while NNPA were at 0.73% versus 0.81% in quarter on quarter basis.
Right, so that's with regards to Aavas Financials. Akshay, what are charts indicating with this stock? And apart from Aavas, anything else that comes to your radar from the sector which looks interesting?
Well, Aavas Financials has seen some bit of profit taking or kind of a sell-off from the levels of 2200. Primarily, my understanding is this was a bit overstretched on the short-term charts. That's the reason you have a cool-off phase. Broadly, this stock is still strong on the price patterns. 1980 zone is a strong support if you're a short-term trader, and my sense is that you will have another round of short-term recovery from the supports which I mentioned. So in case someone has a buy position, the view continues to be positive. Roughly 1950 is the support zone. You can place your stop losses below the support and continue to hold. The target projections roughly work out till 2200. That's the short-term target with a time horizon of a month, and longer term you can continue to hold the stock till it trades above 1950.
Okay. Mr. Chokalingam, your view?
I would give a sell call. Yes, the quality of asset is fabulous, no doubt about it. But price to book value is around 3.6 times. In this market, I am not comfortable with 3.6 times, valuation multiple. One can consider a maximum around 3 times. So which means anywhere around 650 to 1700 would be fair price in my view for Aavas Financials.
Got it. Moving on, let's focus on the Laurus Lab, which is a stock we should focus on. The stock recovered its intraday after falling 5% despite posting a good quarter. Now, the profit tripled on a yearly basis due to a boost in the other income. And we spoke to the founder and CEO, Satyanarayana Chava, about the quarter gone by and the outlook for FY26. Listen in.
How do you rate the quarter,
Vedas.
sir? Because when I look at the exit margins that have come in into quarter 4, I'm starting with the minutiae first, the margins, because it was such a big talking point, right, all through FY25. What do you do? Do you end at 20%? Do you do higher? The exit margins are good. Even though your average margins are not 20 but 18, but the exit margins are very strong. What went into that quarter for the exit margins to be what they are? And what's the color that you can provide for the quarters ahead, sir?
Vedas, good morning. As we were talking in the previous quarters, we guided our investors. The H2 FY25 is going to be good, and we delivered those numbers. When we delivered 20% in Q3, then people were thinking, unless we do over 25% EBITDA for Q4, we'll never be able to get an average of 20. Interestingly, we did that. And that was because of higher revenue share coming from CDMO. And we could see some leverage happening in our asset utilization.
Right, so that's with regards to Laurus Laboratories. Mr. Chokalingam, how are you looking at the pharma space, taking into consideration what's happening on the domestic front? Plus, you have, the impact that could be coming in on the back of tariffs and the kind of opportunities are lying for the CDMO place as well. How are you? What's your view?
Yeah, I'm a little cautious on exporters, extremely bullish on the domestic pharmaceutical companies. Yes, this morning also we saw in the media that the US Secretary of State has mentioned that India is the first country to come to negotiate table and do talk on bilateral trade relations. So which is a very big positive. I believe that 26% reciprocal tariff may not happen for Indian pharmaceutical products, but still, even if it is hiked by 10%, I think the exporters will have a significant hit because last 2 years we know the pharmaceutical companies which were exporting to America have been under a little stress in terms of the realization and the demand growth. So therefore, I am more bullish on the domestic pharmaceutical companies.
Got it. And Akshay, Laurus Lab on the chart, how does that look?
Well, since the beginning of this year, it's been a choppy, rough ride for the stock. The stock tries to break past its swing highs, but again, there is another round of sharp correction. So roughly what I understand right now is 540 and 660 is more of a short-term trading zone. It's more of a neutral stance. But if you look at the all-time high levels for the stock, it roughly coincides around 690 to 700 zone. So I believe that in the coming months, this stock may make a revisit for levels near 700, which should be a good level to take out your profits in this stock.
That's the view coming in for a Laurus Lab. But another stock I want to talk about is the Patel Engineering. It's buzzing in trade, an intraday high of 5% at the start of trade. It has cooled off as the markets have come off, but this is on back of 2 order wins that the company notified this morning. It was declared the lowest bidder for a 1,300 crore odd contract, which will construct a dam in Maharashtra. And this project is expected to be completed in 42 months. The second order was a 718 crore contract that was received for a 240 megawatt hydroelectric project located in Arunachal Pradesh, which will generate 10,000 million units of energy annually. And the project is expected to be completed in a period of 44 months. Now, since its Q3 results, we've not seen any order win releases notified by the company. So, assuming taking the Q3 FY25 order book, which stood at around 16,396 crores, and if you add the 2 new latest orders that the company has notified, the order book value could be taken to over 18,400 crores. And that's why Patel Engineering is buzzing. But Akshay, Patel Engineering on the charts, how does that look?
Patel Engineering, well, the price structure from a medium-term 3-month perspective is in a falling channel or a trend line where it means that the stock is still in a weaker trend. So as of now, right, 35, 38 is the short-term support zone, which is it is trying to cement, still no confirmations as yet. So I will give this stock a miss because technically still there is no price confirmation about any major directional move. So I would give this stock a miss. To buy in case you are holding. I would recommend to take an exit.
Got it. Thank you, Akshay, for giving us that outlook. And I want to thank both of you all, Mr. Chokalingam as well as Akshay, for coming on the show and helping our viewers with views on the stocks we spoke about. But with that, viewers, that's all we have on the show. But do stay tuned to NDTV Profit. Lots more lined up on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The last 1 month, if you see, the share prices of Lloyds Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India.
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Soumit Sarkar, and my co-anchor Puneet. Well, Puneet, markets have fallen, but then we are seeing a soft recovery. In fact, a strong recovery. Nifty PSU Bank Index is up 1.7%. Nifty Small Cap has recovered nearly 1.6% from day's low.
Well, definitely, and we highlighted in the morning that we've seen the PSU Bank Index fall for the third straight day. And stocks like IOB was one of the key losers in trade today. So definitely seeing some recovery there. Still in the red today, but we're seeing a very strong recovery on that aspect as well. Let's also pull up the Nifty first, as well as the contributors for the Nifty. it has been doing it, as mentioned, a strong recovery that we've seen. Stocks such as Infosys, TCS are in the green right now. SBI Life on the back of its strong Q4 earnings is also back. We're seeing some pressure on stocks like Axis Bank after the company's Q4 earnings yesterday. They did host the analyst call and did mention about provisioning as well in terms of the credit card as well as the personal loans, and that is something that the street is not taking too kindly. Among other things, that the results was largely flat. Let's also look at in terms of the mid cap and the small cap performance, if that has improved a bit compared to the benchmark indices, not so much at all. We're seeing just some recovery from the day's low. Days was about 200 odd points on the mid cap, 150 on the small cap, 250. We have seen currently down 2.28%. And again, a 200-point recovery on the small cap as well. Let's also pull up, the BSE 500 as well, because we've seen a whole host of stocks today that have been, buzzing essentially on the back of Q4 earnings as well. Sterlite is up 5%, and yesterday we did see a big 25%, sharp, downtrend on Sterlite on the back of the demerger of the business. Restaurant Brands Asia is also up about 4.5% up. Emphasis on the back of, as well as Persistent, if I can highlight that, on the back of strong Q4 earnings for both of those players. Very decent commentary as well to go looking forward into FY26. On the loser side, some pressure on SBI Cards after earnings as well. Cyient, another one, as well as L&T Tech on the back of earnings. But overall, we've seen a day today that has been largely, dominated by news flow in terms of Q4 earnings as well. And, we have Lancelot also joining in. But before I go to Lancelot, let's pull up Tech Mahindra first, because that's the company which is also in focus on the back of its Q4 earnings. Now, very interesting what's happened with Tech Mahindra in today's trading session. Started with a 4% down move. We've seen a stellar recovery on the stock, and that's largely on the back of its Q4 earnings that came in yesterday, as well as some of the key commentaries that the company mentioned in its conference call as well. So first, in terms of earnings specifically, we have seen just about a 0.7% growth in terms of revenue, but EBIT margins come in at 10.5%. Expectation was about 10.3%, so definitely a beat there. We've also seen the profit was up 18% in this particular quarter, coming in at 1167 crores in terms of profits, largely supported by the other income segment, but overall the services business has been growing. The IT segment revenue was at 11,327 crores, and one of the key strong points in this particular results was the deal wins, $798 million in terms of deal wins for Q4. This takes the consolidated TCV to almost $2.7 billion in FY25, and that's up 42% compared to the previous year. So it's a big deal win that the company has managed to do in this year. We've also seen its top three verticals, which is communication, manufacturing, and BFSI, all either contribute flat to positive growth in this quarter. So hence, that was one of the key things. The other aspect which might have led the stock to be under pressure was in terms of EBIT margins. Now, FY27, the company's vision is to go to 15% EBIT margins. Currently, between 10 and 11% is where it is. And in terms of brokerages as well, that's the reason we saw some, in terms of brokerages like Macquarie as well as Citi being bearish. But I want to pick up Kotak first in terms of, the brokerages specifically, because we did see some in terms of three key points that they are making. They've mentioned that, deal wins is providing them the much needed portfolio shift to high margin businesses. The second point they are making is that they believe that the company is on track because of these, high margin deal wins to reach that 15% EBIT margin target. And finally, they're saying that a successful turnaround, which is the base case scenario, should lead to a re-rating in the multiple. And similar view coming from Investec, they actually have a target price of 1,672 rupees per share as well. And again, they mentioned that, they believe that this is the highest growth in terms of deal wins versus peer group, as well as, that company could potentially be the highest growth in the next decade. But Lancelot, good afternoon, and thanks so much for joining in today. I just wanted to start off with the IT space as a whole. We've seen Tech Mahindra come in with good earnings today. Emphasis also strong earnings, but some pressure on stocks such as LTTS after earnings as well. What do you make of the, and Cyient as well, another one which is under pressure because of earnings. So how are you viewing these 3-4 companies in terms of earnings, and any pick that you have to look out for, at least in IT?
I think, these companies are in different spaces because, L&T Tech is actually providing engineering services software, whereas Tech Mahindra are more into the telecom as well as the general software that we are seeing, software services across various categories like banking, financial services, insurance, etc. So they are mostly in the implementation services as well as in the maintenance services. Now, I think that space, while Tech Mahindra did get significant deal wins in this quarter, whatever we hear from the commentary is that maybe going forward, things are taking a little bit of a pause from most of the companies in the light of what's happening globally. So we may see the subsequent quarters, things may slow down a bit. And so given that background, I think, Tech Mahindra is probably fairly valued at this point in time. And yes, you might see if the growth does continue, then it would mean a kind of a re-rating as far as Tech Mahindra is concerned. And as far as the space is concerned, I think, at the end of the day, AI, cloud services, digitization, these are all the areas where there is a lot of work still that needs to be done, and there is integration of various platforms that will be required. And most of these companies are poised to provide services in those spaces. So I do believe that it's just a matter of some time before work gets allocated, and these companies are able to then grow their their book size accordingly. So the space is good. Valuations are not that high at the moment, so one can look at slowly adding to the sector and to the good companies in the sector over a period of time.
Well, another stock that remains in focus is Axis Bank. Now, the bank's Q4 profits were ahead of the estimates, but the loan growth number was a bit disappointing. Let's go across to Harsh with more details on the Q4 numbers.
When you're looking at the overall set, it looks like a decent set that's coming from Axis. Margin expansion of 4 basis points, that's a bit of a surprise. Didn't expect that coming from Axis. The NII number was a slight miss, but that's largely driven because loan growth came in lower and not because margins were compromised. So margins actually have gotten better, which is the positive surprise. But where your NII number is concerned, it's a slightly softer number, but that's largely led by loan growth. Loan growth was extremely soft. Something to keep in mind, again, just 8% up YOY, the loan growth. And missing estimates, maybe by around 1.5% at the very least. So maybe that's something to keep in mind. The other piece is with regard to OPEX. OPEX was elevated, operating profit largely in line. You saw provisions number largely lower, in fact sharply lower when you're looking at it sequentially as well. Credit costs were down around 30 basis points, came in at just 0.5%, and profit after tax therefore got a lift. Your ROA hit 1.8%, your ROE hit 17%. Both of those metrics extremely strong, given the fact that that's the aspirational ROA, ROE of Axis, and they haven't been able to do that, and therefore clearly a positive, but disappointing in a big fashion with regard to growth. Just 8% on loans, just 10% on deposits, not looking good from that perspective. 7% QOQ deposit growth looking very impressive. So on the QOQ number, it's very solid. But on the YOY number, loans, overall disappointment, deposits also disappointing.
Lancelot, coming to you on the Axis Bank number, yes, deposit growth has been a bit slower, loan growth has been a bit slower, but how are you looking at the overall numbers given the fact that things are expected to improve now going forward?
So I think, everybody knew that we were coming off a difficult year for the banking space because, you had seen interest rates high. Most of the banks were struggling to attract CASA deposits. And because of which, they were forced to borrow at higher rates and margins were impacted. So while the bigger banks like, ICICI, SBI, etc., and HDFC have been able to probably expand their loan book a bit faster because they have a larger access to, corporate lending. We have seen that, companies like Axis have struggled to do that. But going forward, I think the environment has changed, and that is also evident in the last quarter loan growth. So you can see that the environment having changed to a lower interest regime should spur some amount of loan growth, as well as companies, as well as individuals will start to borrow a lot more. So I think going forward, you expect to see maybe a higher loan growth going forward, and that should compensate, and if valuations are like down because of the stock is down, that gives you an attractive opportunity to enter into the stock and hold it for the upside when it comes.
Got the view, Lancelot. Another stock that's in focus is Macrotech Developers. Now, the company recorded strong Q4 earnings. They also beat its FY25 pre-sales guidance of 17,000 crore rupees, and its net debt also reduced by 320 crores. What were some of the other key highlights from the earnings? My colleague Anushi joins in with more on this. Anushi.
Shares of Macrotech Developers are in focus after they have posted a strong set of Q4 numbers. Now, some of the key highlights, if we see of the quarter, firstly, it's the pre-sales which were in focus even after the business update that we've seen. The company has beat its FY25 guidance of pre-sales, which was at 17,000 crore. In fact, if you look at the FY25 picture, they've registered about 30% of growth of pre-sales from its new launches in 2025. Along with that, they've added 10 new projects with a GDV size of 23,000 crore, which was against the guidance of 21,000 crore as well. So strong beat here also that we are looking. Net debt to equity continues to remain at 0.2 times, which is below the ceiling level of 0.5x that we've seen. Now, if we just talk about the four general numbers of the quarter gone by, revenue was up around 5%, margins on expansion of 284 basis points to 28.89%. Net profit saw growth of around 38%. But do note, for real estate companies, it's the key operational numbers which are in importance, wherein we saw about a 14% of a pre-sales growth in the fourth quarter. Collections also strong growth here at 26%, and they added 2 new projects in Pune with a GDV value of 4,300 crore. What's interesting to note is the kind of outlook that the company came out with for FY26, wherein they expect a 19% of a growth in pre-sales in line with their target of seeing around a 50,000 crore of pre-sales in the next couple of years that we are seeing. So pre-sales expected at 21,000 crore for FY26. Operating cash flow is expected at 7,700 crore, so 17% of a growth here as well. And they expect net project additions of 25,000 crore as compared to 23,700 crore, which we saw in this financial year. Net debt to equity to continue remain below 0.5 times of level that we are seeing. So this is the overall roundup of Macrotech Developers in Q4 and what's the outlook for FY26.
Well, thanks for that, Anushi. Lancelot, coming back to you, how do you view specifically Macrotech Developers earnings, and if you have any preference in the real estate space, what are your topics?
So I think, I did look at Macrotech Developers with the earnings coming out, and it seems like they have a lot of traction in the lower income segment, which is, probably in the less than 1 crore segment. And then there is a lot of traction in the super luxury segment. So in these two segments they've seen, but there is a bit of a slowdown maybe or a lower growth rate in the middle segment. And that should, probably indicates that with maybe interest rates easing up, we could see some improvement coming up in that segment as well. But for the company to maintain the strong growth rate that it has, shown so far in the past, is also going to take a lot more, effort, and acquisition of new projects and land will also be key in how they grow. From a valuation perspective, stock is reasonably well priced. I think most of the positives already in the price. So there's not much one can do at this point in time.
Moving on, speaking on the sidelines of the India Steel Conclave 2025, my colleague Sajid spoke to the Steel Secretary Sandeep Pondrik. He talked about the road ahead for the India's steel sector. Listen into that slice of the conversation.
We're in a very exciting times globally as well as domestically, because the kind of targets which Prime Minister has set for the industry is also a big challenge in terms of how to scale it up to that level. How do you see the Indian production and the capabilities going from 2025 to say 2030 and then to 2047?
So basically, as you know, that India is the only major economy where consumption is growing very fast. And that is primarily because, number one, the economy is growing fast. Secondly, that the government is pushing a lot on the infrastructure. Private sector development is also taking place. So there's another factor that we have just crossed about 100 kg per capita benchmark. And it has been seen that when a country is around 100 kg, then the elasticity of steel demand with respect to GDP growth, it goes up. So right now, if you see the data, our elasticity has been above 1.5 for last 2-3 years. So basically, the consumption is expected to grow. Now, to match that consumption, we have to increase the capacity. In last year alone, we have added about 21 million ton of capacity in the country. From 179, we have reached 200 million tons. If you see in last few years, we have doubled our capacity from 100 to 200 million ton in a period of about 6-7 years. What is expected is, if you take into account the plans of ISPs like Jindals or Tatas or SAIL, they have ambitious plans. About 30 million ton is already under implementation. Another 50 million ton is under planning. And then the secondary steel sector is also growing. So our expectation is that by 2030, we should definitely cross 300 million tons. That is, we should add up about 100 million tons in next 6 years.
Well, in the same event as well, my colleague Sajid also spoke to Amarendu Prakash, the chairman at SAIL, who talked about achieving 75% steel capacity by 2030. Listen in to a slice of their conversation.
We are at the India Steel 2025, and there is a good target which has been given for the domestic industry of PSU as well as private sector. The first being the 300 million tons target for 2030. How geared are you as SAIL, India's largest, one of the largest public sector firms, to meet that kind of challenge?
So you see, Sajid, if we look at India's capacity today, it is around about 200 million ton, and it's trying to get to 300 million ton in another 5 to 6 years time. SAIL is currently at 20 million ton, and we are trying to get to 35 million ton by the end of this decade. So 75% increase in capacity by 2030.
So where is that capacity coming in? It will be a capex, and will it be greenfield, or will you be doing a brownfield expansion?
So as you know, we have 5 steel making locations at Bhilai, Rourkela, Bokaro, Durgapur, Burnpur. 4 million ton is coming at Burnpur. 3 million ton is already in motion at Bokaro. 3 million ton is brownfield across all these plants. That is stretching the old capacity to bring in brownfield expansion. And further 5 million ton is planned for Rourkela.
And what is the kind of capex allocation that you're looking at?
That's the pain point. The capex naturally, as you know, in the steel industry is high. So this 15 million ton, we expect to take about 1,30,000 crores.
And do you see today, as we speak, the industry pricing of steel, which is there, is good enough to generate enough cash flows to fund that kind of cash flow capex?
As if I take the average prices of last 1-2 years, no. But we hope government has announced a safeguard duty based on data. See, we are a pretty competitive industry in India. When we make steel in India, it is pretty competitive. We are efficient. However, when steel from some countries where there is excess capacity, low consumption,